So good morning, everyone. My name's David Aikman. I'm the director of the Qatar Centre for Global Banking and Finance at King's Business School. And it's my great pleasure to welcome you to today's policy forum on firms' climate-related disclosures. There are still no universally adopted standards for how companies can measure and report on how exposed they are to climate risks. A recently published report by a working group of the G30, chaired by Janet Yellen and Mark Carney, emphasized that consistent and comparable disclosures are a key precondition in financing the transition to a low carbon economy. Now, this might all be about to change. In September, the IFRS Foundation, which is the body that oversees the development of international financial reporting standards for most companies around the world, issued a consultation paper with some proposals for how climate reporting can be integrated alongside firms' existing reports. And today's forum will debate the issues that the IFRS Foundation will need to grapple with in designing a coherent set of global climate reporting standards. We have a stellar lineup of speakers to debate these issues, including academics, practitioners, and those at the coalface in the development of disclosure standards. Let me emphasize that today's event is a public one. It's being recorded, and the recording will be submitted as part of the consultation process. We also have an opportunity for those in the audience to pose questions to speakers and panelists. If you'd like to do so at any stage, there's a Q&A box that you'll find at the bottom of your screens if you hover your mouse over the Zoom webinar. So please use that Q&A box freely. Now, to kick things off, it's my great honor to introduce Lord Adair Turner to give our keynote address. Amongst the many distinctions in Lord Turner's career, he was the first chair of the Climate Change Committee in 2008. He also led the UK Financial Services Authority at that time and played a leading role in redesigning global financial standards in the aftermath of the global financial crisis. He now chairs the Energy Transitions Commission and is a senior fellow at the Institutes for New Economic Thinking. So Lord Turner, welcome. It's a great pleasure to have you here, and the floor is yours.
Thank you very much indeed. It's a pleasure to join you for this discussion. The issue of financial standards is, of course, an incredibly detailed one, both in all its governance arrangements, who set standards, what is in the standard, how are they enforced, etc. And obviously, the IFRS has a crucial role to play in that respect. And because I'm not an expert, I'm not deeply involved in those issues at the moment, I'm not going to talk about some of those detailed issues. What I'm going to try and do is provide an overview background on what is it that we need financial disclosure to achieve, what sets of problems related to climate change and the energy transition do we have to find the solution to. So I'm going to make a few comments about the overall progress towards a zero carbon economy, the challenges that creates in terms of what we mean by commitments to reduce emissions, and then some specific points on 4 particular categories of things that we might want to achieve by effective financial disclosure. So I talk, as has already been said, as chairman of the Energy Transitions Commission, which is a global coalition of mainly companies from across the world, but also climate experts and environmental groups, all committed to achieving a limit of global warming to 1.5 degrees centigrade, which broadly speaking means that we've got to get to about net zero emissions by mid-century. The good news, and it's really good news of the last 5 to 10 years, is that we now have a much clearer vision of how to achieve that than we had 10 years ago when I was the first chair of the UK's Climate Change Committee. And in part, the clarity has come from the extraordinary power of technological advance and cost reduction and endogenously induced technological advance and cost reduction. And what I mean by that is that compared with the figures that we were looking at in the Climate Change Committee 10 years ago, the cost of solar PV is now down 85 or 90%. The cost of wind down 60%. The cost of batteries down 85%. We have seen these extraordinary breakthroughs, but they have been endogenously induced because it was the very fact that we set targets, that we did initial subsidies, which enabled those industries to achieve economies of scale and learning curve effects, which delivered reductions in cost which would not otherwise occur. You put all that together, and I won't go through the details, we've set it out in our reports, a recent one, for instance, called Making Mission Possible, which you can see on our website. Put that all together, and we now have a vision of how to build a zero carbon economy with, at the absolute core of it, electrification of as much of the economy as possible and decarbonization of electricity systems as fast as possible. There are other things we need to do as well. There is a role for bioenergy. There is a very significant role for hydrogen, which is a vector in the long term of using green electricity to turn into hydrogen and to use. And there's a role for carbon capture and storage. But at the absolute core of it, I put green electrification either directly or via the electrolysis of hydrogen and the use of hydrogen and hydrogen derivatives. This is a clear vision we can now have of how to build a zero carbon economy. And it includes some very strong implications for the future role of fossil fuels by 2050. It is really impossible to imagine a zero carbon economy which does not involve an almost complete elimination of the use of thermal coal, coal to burn to produce electricity as against coking coal for steel, a very significant reduction in the use of oil, and Spencer Dale from BP is on this call. And if you look at their latest scenarios, they are setting out very dramatic reductions, maybe 75% or so, as being needed in the use of oil in the world by 2050, and even gas, which until recently was seen as a major area of growth in terms of fossil fuels for a sustained period of time, we believe will have to come down maybe by as much as 50% by 2050. It depends how much hydrogen you make out of gas as what's called blue hydrogen, not coming down as much as coal and oil, but not going through a major expansion. This is a very dramatic change in the shape of the energy system. It requires a very high degree, a large amount of investment. In total macroeconomic terms, that investment is not worrying. The measures of estimates of the incremental investment that we need at the global economy level are of the order of magnitude 1 to 1.5% of GDP. And in a world where we already save and invest 25% of GDP, and where the pattern of existing long-term real interest rates seems to be signaling to us that there is, as it were, too much ex-ante savings pursuing inadequate amounts of investment and therefore producing these very, very low real interest rates. In that environment, mobilizing extra investment should not be a problem. But it does require a very major reallocation of investment, less investment in a fossil fuel a production and much more in renewable energy, electricity, transmission systems, distribution systems. Less investment in factories to make internal combustion engines, major investment in factories to make batteries and to make electrolyzer equipment and to make EVs. All the way across the economy, a net increase in investment, which is absolutely doable in macroeconomic terms, but a very major reallocation of investment from the categories of investment we were previously doing to new categories of investment. Now, that is possible. And one of the things that will drive it is companies and financial institutions making commitments to drive it, and in particular, making commitments themselves to be net zero in their emissions by mid-century, typically by 2050. And one of the really welcome things of the last few years, and really accelerating over the last year, is the huge range of companies and financial institutions, companies from many sectors, making net zero commitments. BP and Shell and Total from the oil and gas sector, ArcelorMittal and Tata and SSAB and ThyssenKrupp from the steel sector, Dalmia Cement and the Global Cement and Concrete Association from the cement sector, Maersk in container shipping. All the way across the economy, we have these commitments of companies saying, our strategy will now involve us being net zero in our emissions by 2050. And we have we have financial institutions making those commitments as well. HSBC, BNP, Allianz, the many investors involved in the Net Zero Asset Owners Alliance. And these are very important commitments because they drive individual changes in strategy. And they also drive a very important three-way relationship between three things. One, companies making commitments itself drives investments, which drives that endogenous process of technological change, which reduces the costs, which makes it easier to meet those commitments. And the fact that the cost has come down, and the fact that companies and financial institutions are making those commitments, makes it easier for governments to make those commitments. And so this year we have seen a continual set of new commitments from governments, from China at the United Nations in September to be carbon neutral before 2060, quickly followed by both Korea and Japan committing to be zero by 2050. And the moment you have Korea and Japan saying zero by 2050, then POSCO, the biggest Korean steel producer, or Nippon Steel in Japan, themselves have to make a commitment to zero carbon and start working on it. So what we have seen, and I think it's important to realize this has, and we couldn't have predicted it, been a very favorable year for the progress about climate change, in which this relationship between what is happening on technology and cost, what is happening on company commitments, what is happening on a financial institution, an asset owner and bank commitments, and what is happening in a country commitments. And of course, I didn't mention the one which, along with China, is the most important of all, which is the election of the new Biden administration with a commitment to be net zero by 2050. This is producing a very powerful self-reinforcing effect. But it creates some very major challenges, some complex challenges in relation to what do commitments mean, and how does financial disclosure help make sure that when you make commitments, they are meaningful commitments rather than greenwash. And to give you the idea of the problems that companies and people dealing with problems have to deal with, suppose you have a steel company that makes a net zero by 2050 commitment. It says, well, I will be net zero by 2050. And suppose you are a bank trying to work out that you have made a net zero commitment. Is it okay to invest in this steel company rather than the one next door? You really have to engage with what is the nature of that net zero commitment. When a steel company commits to net zero, what do you expect has happened today? Because today, nothing will have happened. They will still be producing steel in the same way as they did before. They can't magically become net zero the next year. So what are the actual investments that you want to see, which make that commitment credible. What do you want to see by 2030? What do you want to see by 2040? The whole issue of credible pathways to an end commitment is a very tricky one in terms of fair disclosure to investors, fair disclosures to bankers, working out that we actually have a currency of communication which is for real. There is also a major issue about how one should invest in existing fossil fuel companies. There is, of course, a major desire across the world in many green movements to drive disinvestment from fossil fuel companies. And I am sympathetic to some aspects of that. But one does have to ask the following question. And it was a question very interestingly posed by Ivan Glassenberg, the head of Glencore, a man with whom I have clashed at the Davos World Economic Forum 2 years ago, but is now about to stand down from a company which has now committed to be net zero by 2050. And he raised the interesting question. He raised this question. He said, look, we're a public company, and we are now committed to be net zero by 2050. We own a set of coal assets. We sell coal to power generators. You can't switch that off tomorrow, because if you did switch that off tomorrow, there'd be a group of people in northern China who would be freezing to death. So somebody's got to give them the coal this year and next year, but they've got to reduce that coal over time. So who do you want to own those coal assets? Do you want those coal assets to be owned by a listed public company with a commitment to be net zero, which has a strategy of taking the cash flow from those coal sales and investing it in the technologies of the future, the minerals of the future like copper and lithium, while investing just enough in those coal mines to keep them safe and producing? Or do you want to force us to divest into the hands of a private equity operator who has no such interest at all and who will continue to invest in the expansion of coal capacity? It is an interesting question. Now, as it happens, I'm still pretty keen on telling people to have some red lines against certainly all new coal investment, but we have to think about issues like that. We also have to think very carefully about stranded assets. There are going to be major stranded assets. Broadly speaking, in order to limit global warming to safe levels, we have got to leave in the ground at least 2/3 of the fossil fuels which we already know are there. We cannot dig them all up. And some of those reserves or resources are on the books of oil companies. To a much greater extent, they're on the books of the national oil companies rather than the IOCs, but some of them are on coal companies or gas companies. And they're going to have to be left in the ground. So we are going to have assets which at current point we think are worth something, but which if we're serious about getting to a net zero commitment, we're going to have to write down and count as zero. And the issue is, what are those? And those exist not only in relation to fossil fuel reserves, but also into blast furnaces to produce steel, or assets to produce internal combustion engines, which will be stranded if we cease making internal combustion engines. So all of this, I think, defines a very complicated environment in which everybody who's involved with financial disclosure and disclosure standards has to start with that analysis and then think through, how do we have fair disclosure which helps the market work and helps companies and banks and investors work in that complicated set of issues? And against that background, I would define 4 sets of areas where financial disclosure and standards have to think about the role that they can play. One is the disclosure of what your own company emissions are. Relatively straightforward in relation to what is called Scope 1 and Scope 2. Scope 1 the actual gas that you are burning in your central heating boilers, and there's CO2 being emitted in your own factory. Scope 2, the purchase of electricity or heat which was generated elsewhere. But the real complexity is Scope 3, the emissions produced by the suppliers who provided you your goods or the users of your goods downstream. And we have to realize that when you get to Scope 3, you are dealing with inherently difficult calculations because they are just complicated calculations. If you are an auto company and you are selling an electric vehicle, your Scope 3 emissions from that electric vehicle will depend on the carbon intensity of the electricity being used in that EV, which will vary both over time and between company. And so you have to have a reasonable point of view of how granular do you get in order to produce at least adequately good estimates of what are Scope 3 emissions. So that's one area of importance, just getting the emissions disclosures right. The second area, of course, is the issue of reserves and resources, particularly for fossil fuel companies. What are the reserves on their balance sheet worth, and which of those might be stranded over time? And that, of course, depends on the cost of producing those reserves, whether they are high cost to produce or not. Broadly speaking, a world of, suppose we ended up with a world of just 15 million barrels a day of oil in being produced in 2050, the best guess is that at least 10 of them would be produced in Saudi, because that's the cheapest place in the world to produce oil. In which case, anybody who's sitting on reserves which last all the way out to 2050, if they are higher marginal cost than producing it on Saudi, is probably sitting on a stranded asset. But that whole issue of clarity of the value of reserves is clearly a crucially important issue in that particular sector of the economy. A third issue, however, is what I call strategies and commitments. If we have investors, but whether they be debt investors, banks lending money, or equity investors making equity investments, who want to be able to design their strategies to support the transition to a zero carbon economy, they have to be able to interrogate companies on what their strategies are, and they have to be able to make sense of what a net zero commitment by a steel company, a cement company, or a car company means. And that is inherently difficult because all the timing and transition issues which you have described earlier. But we will need to create some sort of language of disclosure and some discipline of disclosure, whereby when a company says, I am committed to net zero by 2050 and to a 50% reduction by 2030, that we have some way of working out whether that is credible or not. One of the key issues there, by the way, is when you say net zero, what did net mean? Did it mean that you were committed to actually reducing the emissions within your steel business or your aviation business or your shipping business? Or did it mean that you were assuming that by 2050 or 2030, you would be buying offsets at a lower carbon price, maybe, than it would cost you to reduce your own emissions? And there we need some sort of discipline on our assumptions about offsets, because anybody can assume that there will be net zero by 2050 if they assume that there will be a large number of offsets available at a low price. The issue of offsets is an area of potential huge vagueness and indiscipline within the promises to net zero that are being made. Now, that is complicated enough in relation to an individual steel company or car company to, as it were, discipline what is meant by a net zero commitment. It gets even more complicated when you get an asset owner or a bank saying to its investors, my strategy is compatible with net zero, because then you've got to look through to what is it about the whole of their portfolio and the way that they related to those end companies, which was in itself compatible with net zero. You have two layers of complexity, working out what net zero means at the level of the companies that they invest, and then working out what that means for their overall portfolio. So these, to me, are the categories of questions that we have to address in disclosure. Clarity of the actual emissions, scope 1, scope 2, but actually really the most complicated, scope 3. Clarity about reserves, in particular for companies that have forms of natural resource reserves. Clarity about strategies and commitments made by non-financial institutions. What precisely do those mean? How do we discipline them? And how in particular do we bring discipline to the issue of to assumptions about offsets as against within company actions, and the extra complexity of what that means for a financial institution investing in those companies and the disclosures that it then makes about its own portfolios. So I hope that that has given a point of view as to at least the problems which the experts on financial disclosure and accounting standards needs to address. Thank you.
Thank you very much, Lord Turner. That was an incredibly clear, wide-ranging opening for us. Let me just encourage our audience members to, I think we have a couple of minutes where we can where Lord Turner can take your questions. So please do post them in the Q&A box at the bottom of your screens. While we're waiting for those, I might ask you one myself, which is, I guess it's, you have touched on this already, but my question would be, what advice would you give to the IFRS Foundation as it proceeds in this area? They're going to need to navigate a whole range of issues, how to handle some of the complexities you've raised. There are a whole series of uncertainties involved in some of the calculations you've outlined. What kind of overarching advice would you like to kind of pass on as part of this?
Well, I think what you've got to engage with, and it's always an issue on financial standards, is the issue between things which are precisely measurable, but which may not actually help us really understand the true fundamental economics. And those ones which would help us understand the true fundamental economics, but are never absolutely precisely measurable and therefore require judgment. And it makes me remember going back to the financial crisis days of 2008, the issue within trading assets of things where you could measure the value at which you bought it, which is the historic book value, but that didn't tell you much at all. Things where you could measure the current market value, which was, in some cases, if it was a liquid asset, a precise value. But what did that tell you if the market value could change dramatically in the next day? And we remember those points in September 2008, where people were saying things like market values have changed over the last 3 days by what we thought was the 6th standard deviation of what they might change over a 10-year period. And so what we ended up with was, what do we think is the real value of these? What is the limit to this? And we actually found that incredibly difficult area. We also had the famous issues of sort of unknown unknowns, what were called the level 3 assets, which had to be measured by reference to things that you weren't quite sure whether they existed or not. And it ended up quite philosophical. But there were some interesting issues about there. When does financial accounting need to realize the limits of what it can do. Can it help solve this problem if financial accounting has to deal with facts? Now, some things we can reduce to facts. I mean, the scope 1, scope 2, scope 3 emissions, we ought to be able to define standards they will have to cut off at a point of granularity, but all accounting does that at some point. It will have to have basis for agreeing it, but at least at the end of the day, there is a fact, and the issue, how close do you get? I think some of the big issues are, how far will the IFRS want to regulate what happens not in the facts in the notes to the accounts, but in the verbal commentary in the CEO and the sort of front end of accounts, right? Where there are statements which are also certified by auditors, right? Because auditors do have to read the front end of accounts. What discipline can we get to a statement when a steel company says, we have a strategy to reduce our emissions by 2030 by X%? Are they just allowed to say that and it's an area of complete indiscipline? Or is there going to be some auditor standard which disciplines that arena? So I think the big issue that the IFRS has to struggle with is, to what extent do accounting standards have to deal with issues of definitive facts which, as it were, exist today, or forward-looking judgments and statements as to what the situation will be in the future. And across many areas, it has experience of having to struggle with that issue. But that issue, I think, is particularly pressing in this area of climate change.
That's wonderful. We have a bunch of problem with asking for questions in Q&A when we have someone of your quality to answer the questions, as we have many. I think in the interest of time, I'm going to ask you the first question that came in, and we will, these questions we can pose to various speakers throughout the day. So this is a question from Benoit Mojon, who asks, how fast do you expect that a critical mass of public corporates would publish their carbon emissions? Can we put in place a rating system of greenness of corporates based on the scope 3 of carbon intensity?
I'm going to mainly respond to the second of those questions. I mean, I don't know how fast we're going to get all these data. I mean, lots and lots of corporations, of course, do voluntarily already. They've been encouraged over the years by a remarkable institution called the Climate Disclosure Project, which is a small group of people who've punched way above their weight in persuading companies to disclose and persuading asset managers to demand that companies disclose. And I'm not an expert on how fast we can expect that to spread, and also how fast we can and we should turn that into required mandatory standards rather than voluntary standards. But let me answer the second question of this. Once you've got that data, scope 1, scope 2, and scope 3, with whatever level of granularity we can get it, what do you do with it? And the answer is, I think you have to be very careful of simply saying, okay, I'm going to do something like take emissions divided by revenue and declare the guy with a low emissions as being a better guy than the guy with higher emissions. Because here's the problem. Law firms don't tend to produce much emissions per revenue, right? It's partly because they have obscenely high revenue, but it's partly because the nature of their business does not have high emissions. And once we decarbonize electricity, they'll have no emissions. We will have to produce steel for forever. And we can eventually make it zero carbon. But right today, we can't make it zero carbon. It will take us time. So right today, somebody has to produce the steel, including the steel, which goes into the wind turbines, which give us zero carbon electricity. So if you said, oh, look, here's this steel mill, and look at its emissions per revenue, they're way, way higher than this legal firm. So as a responsible investor, all I'm going to do is invest in legal firms and not steel companies. That would be absurd, because we've got to invest in steel companies, in the steel companies which are making themselves zero carbon. I actually saw a complete absurdity of this the other day in a charity investment board, which had noticed that it had investment in some public transport companies, including bus companies, which had quite high emissions relative to revenues compared with some entertainment companies and professional services companies, and was therefore suggesting that it might disinvest from this bus company. But the point about a bus company is what it does is help stop people using their cars, which are even more carbon intensive. So I think the crucial thing that comes out of this is both in relation to scope 1 and scope 2, but even also in relation to scope 3, you've got to be intelligent about it. An auto company will have, at the moment, quite high emissions per revenue if we go down to the scope 3 level, because what it produces are cars, and those cars at the moment are putting petrol and diesel into them. But you can't say that's a less responsible company than some company, investing in Goldman Sachs, because Goldman Sachs, by its very nature, doesn't buy a whole load of oil and gas, or investing in a retailer, which won't do that. You have to take the data and compare it with other companies in that sector. You have to look at that data and see the trend over time. You have to relate that data to what the company strategy is. And you have to use that data as an investor with an engagement with that company to say, how are you going to reduce that over time? But you can't simply take the data and say, guys with high emissions per revenue, bad, guys with low emissions per revenue, good, because there are some things in our economy which are inherently high emissions today, and some things which are inherently low emissions.
Wonderful. Okay, let me thank you for a brilliant start to our proceedings today. It's really great of you to spend the time and sharing your thoughts. And let me move on to our next speakers. So I'd like to introduce Lucrezia Reichlin. Lucrezia is Professor of Economics at London Business School, and also as one of the trustees of the IFRS Foundation is leading its work in this area. So Lucrezia is going to introduce the IFRS Foundation's conduct and the issues it raises. Lucrezia, we do need to finish at 45, if that's in line with your speaking. Sorry, I'm a little bit late at this stage.
I'm here talking with my hat as a trustee of the IFRS and chair of the task force that presented the consultation paper that we are asking stakeholders to comment, and that's been published in our website at the end of September. The consultation will go on until the end of December. So the background of our consultation is that the growing demand in the last few years for sustainability reporting. And here I'm not talking only about climate, but also other aspects of sustainability. And this demand has actually come from investors and from the wider community of stakeholders. There has been also important work carried out by 5 organizations, standard setters on sustainability, SASB and others, and also great work by the task force, the TCFD task force, which has been quite successful in pushing its recommendation through the corporate sectors. beside that, important regional initiatives have also taken place, and here the European Union in particular, but also others. Now, with this background, however, the problem is that, suggestions, recommendations have been there, and now, we have almost too many suggestions and recommendations. So the current environment is one of fragmentation. There are up to 1,700 different metrics available for companies to consider. And not understandably, there has been a call for harmonization from the world of investors about, making the next step, which and try to consolidate the existing efforts, or going for, harmonized, comparable standards. So in a way, there is no lack of standards, but there is lack of comparability, consistent, and this, of course, is very important for compliance. So if the next step the next step now will have to be to go from voluntary to mandatory standards, which are credible and auditable. And this, of course, requires harmonization and building possibly a global infrastructure which would, provide that platform. And some in our pre-consultation have argued that the IFRS should play a role in this effort. So the IFRS Foundation, the trustees, review the strategy every 5 years. And we are now preparing for this review of the strategy. So we have taken in that context the sustainability as a separate topic, and prepared this consultation paper, which has been the work of a task force which I've chaired, and has benefited from discussions with different stakeholders and of course the trustees. So I want to just give you a few words about the way in which this paper has been prepared, and what's the philosophy of the paper, if you want. It is important to understand that whatever the IFRS will end up doing or in this area, this will have to be the result of a process which is demand driven. Okay, so that if there is a demand for us to go in that area, we will move in that area. And this is the first observation. The second observation is that there is a logic in the sequence of the questions that we ask in the consultation. So in a way, the sequence is kind of general to specific. So the first question is there a need for a global set of internationally recognized sustainability reporting standards? Okay, so this is a question that seems obvious. Seems obvious to some, but is actually not obvious, because an alternative could be that certain regions go ahead, and de facto there will be kind of a de facto convergence through by some regions who could lead by example. Okay, so the question is global interest. And if yes, should the IFRS Foundation play a role in setting these standards, which would imply for us to expand our standard setting activity into this area? And then, of course, the other question is, how should this happen? How should we do this? Then, of course, there are a number of questions on criteria for success and what should be the scope of the standards. What should be the concept of sustainability, materiality, assurance, very other topics which, which we are consulting on. Now, so on the mandate, I think it is our intention that we need to proceed top up. As I said, there are many organizations which are already in this area. And one process could be, try to consolidate in an effort, bottom-up effort to consolidate work of the organization. We think that, and this partly motivates this consultation, that it would be more effective and also more speedy, if you want, a process which would be top down, so that the existing institutions and regulators globally would actually decide to go for it, and decide also who should do it and who should federate and try to work and to do this work of towards comparability and so on, based on the existing work. So our preferred approach, okay. So the first observation, is demand driven. Second observation is that this demand should be in a way expressed top down, okay, by the regulators internationally. And then, provided that these conditions are respected, then we indicate in the document a preferred approach. And what we indicate as our preferred approach is the establishment of a new sustainability standard board to work alongside the existing international accounting standard board. And this is the ISB, set financial reporting standards. So this new board will operate within the three-tier governance structure of the IFRS, which sees a monitoring board where the regulators and the FSB and so on sit in, an independent, which the board which oversight the work, monitors the work of the trustees. We are an independent set, group of trustees, the board of trustees, and then below the trustees there is the technical board, the ISB. So that's what I call the three-tier structures. The advantages of this structure is that the regulators and the public authorities sit in the monitoring board, and this, provide some legitimacy to this to the standard setting process. Also, the advantage of this structure is that it provides the connectivity between the regulators, private sectors, and policymakers. And indeed, this structure has been successful for setting financial reporting standards globally. Today, there are over 140 jurisdictions which require the use of IFRS standards by all or most publicly listed companies. The second advantage of this structure is the connectivity with financial reporting. So we see this new board for sustainability reporting as independent from the ISB, but connected. Clearly, there are obvious synergies between the existing financial reporting frameworks and the future of sustainability reporting. These financial reporting and sustainability reporting frameworks in our view are not at the expense of each other. And these frameworks should also include a high degree of correlation and connectivity where possible. Now, having said that, few words about how we propose to proceed. First of all, we recognize that sustainability is a broader concept than climate, but we propose to start with climate. And so to start with climate-related risk, since we think, and this has also been voiced in our pre-consultation, that this is the most urgent task that is there to complete. And we also recognize that there is some important aspect, some important correlation between climate-related risk and other aspects of sustainability. So we propose to start with climate, but not to close the door for expanding the scope possibly in the future. The second important thing is that we build on, we propose to build, of course, on existing knowledge. The IFRS, as it is, does not have the expertise for for doing climate-related risk standards. So the new board will have to absorb the expertise which is out there and build on existing knowledge. In particular, we are thinking of, the possibility of absorbing some capacity of the TCFD. The TCFD is a task force which will have to find a house. So the new board, under the structure of the IFRS, could absorb some of that capacity and also the capacity of other standard setters. But remaining, whether those organizations will possibly will remain, which have broader scope, will continue to exist as a source of inspiration in the evolution of the standard setting work. The third aspect of this third thing that we propose is that we are not, when we are thinking about global standards, we are not proposing the new board to compete with existing regional national initiatives, which some of which are very advanced and ambitious. But actually, what we would like, our aspiration is to offer a platform which would favor global harmonization and at the same time provide some connectivity with financial reporting. And this articulation between regional and global is a key for success. I will talk about it more in detail in the last panel today. We have to recognize that public policy, legal framework varies across countries, so it is inevitable that the standards will be set with a different degree of ambitions in different countries, jurisdictions. Although, of course, we have an aspiration of, global convergence. This is not something that can be achieved day one. So we have to see this in a dynamic way. And the way in which we see that is to follow a nested approach to establish a global core of standards, and then which would be nested in a broader framework. So where some regions can actually aspire to be more ambitious. And then, with time, possibly, there will be progress towards global harmonization. But it's very important that the approach would be nested so as not to start from completely different starting point. Last point, we approach, so there is a discussion out there about the single versus double materiality. Where the single materiality means focusing on the risk related to the value of the company, while double materiality also considers the risk that the company have for the environment. Now, for financial accounts, the IFRS focus on the single materiality. So, what are the consideration for the value of the companies? We recognize that in the issues of climate and sustainability, the distinction between these two levels of materiality is not that clear, because it really depends on what is the horizon you have in mind when you think about the value of the company. But we propose to start with focus on the value of the company, although, there is the issues of, what the horizon cannot be just the horizon that is considered for financial account, but it should be a longer horizon. And then, think that with time, we could actually aspire to have a broader approach. And I think this has been called by Clara Barbie, who will talk later, dynamic materiality. So to start narrow, but aspire to become broader with time. So basically, two keywords: a nested approach and a dynamic approach. So standards-based, a core for global standards, nested in a broader, more ambitious scope. In terms of our timeline, I'm concluding here. the consultation ends at the end of December. In January, the trustees will assess the result of the deliberation, engage with the monitoring board, which oversight us, and in parallel, if we'll get the go-ahead, we will start, a 3-month consultation on our necessary constitutional changes. And at that point, there will be an appointment of a high-level committee to design the governance and identify the exact expertise to carry the job. Thank you.
Wonderful. Thank you very much, Lucrezia. We're going to return to these issues in the 4th panel. Without further ado, let me kind of move on to our first panel, and I'll introduce Morgan Slebos, who will lead the discussion here. Morgan, over to you.
Great. Thanks, David. And welcome to everyone joining us for this session. What are the goals of harmonised sustainability reporting, and what principles should guide this development? As David said, my name is Morgan Slebos. I'm the Director of Sustainable Markets at the PRI. Very excited to chair the session. As set out in the opening remarks by Lord Turner and Lucrezia, I think you've seen a groundswell of support for change in the sustainability reporting system. I think the case is clear for consistent and comparable sustainability information has really been made this year. In particular, issuers and users are demanding better disclosures of climate risk and sustainability indicators. During this session, we will focus on the high-level objectives of global climate disclosure standards, and I would actually argue more widely for sustainability reporting, as well as discuss the principles that should underpin their development and highlighting some of the thorny conceptual issues that we need to grapple with, particularly what the objectives or logic of disclosure should be, the financial stability case for disclosure, and the overarching purpose and desired outcomes of standards from a user perspective. I'm joined by 2 leading experts. First, we have Dr. Paul Fisher, Fellow at the Cambridge Institute for Sustainability Leadership. He currently chairs the London Building Market Association, is a non-executive director at the UK Debt Management Office. He's also a visiting professor at the London Institute for Banking and Finance and at Richmond, the American International University in London. In 2017, he was a member of the high-level expert group on sustainable finance at the European Commission and the UK Green Finance Task Force. We also have Dr. Megan Bowman, Director of Climate Law and Governance Centre, King's College London. Dr. Bowman joined King's in August 2015 and has been appointed at the Dixon School of Law, Rising Star. Her expertise focuses on transnational analyses of climate finance, commercial and financial regulation, and corporate ethics. Thank you both for joining us today. I'm going to invite both the panelists to provide some opening remarks. And then we'll have some discussion with some questions from the audience. So to the audience, we want you to address your questions as well. So please send these throughout the session. So without further ado, Megan, if I could ask you to kick off with your remarks, please.
Thank you very much, Morgan, and thank you also to David and the organisers of this very timely event. So the place that I want to begin really is focusing on the objectives or the logic of sustainability disclosure. And I think this is important for measuring the distance to target of whether we're accomplishing the goals of reporting rather than just doing it for its own sake. So I like to conceive of the logic of disclosure as a trident with 3 prongs, and I'm going to talk us through that. So I think it's best illustrated, this logic of disclosure, actually by focusing on the zeitgeist of climate-related reporting. So the first prong of this trident really points to the macroeconomic level, and the logic of this prong is that when investors have more information, then markets can price risks earlier, with the result of a more orderly or graduated series of smaller price corrections over time. And the objective here is to avoid a Minsky moment brought on by sudden repricing of carbon-intensive assets that trigger some kind of fire sale by distressed investors with disastrous whole of market consequences due to the interconnected nature of the global economy. This prong also enables regulators to assess the progress of supervised firms and therefore really the status of market health generally regarding an orderly transition, something that I'm sure Paul will speak to. So this leads into the second prong of disclosure logic, which points to the market level, market participants. And, really investors need accurate information to inform capital allocation decisions. That's the point. And the objective here is that in a carbon-constrained world, a virtuous feedback loop can occur where investors increasingly invest in greener companies, and greener companies can proliferate through getting competitive advantage and attracting investment. So there is also the logic here that investors and shareholders will agitate for better information and eventually better climate action by companies. The third prong points to the micro level of individual companies, so it really points inwards. And by preparing a report, the idea is that the company itself can see its own vulnerabilities and impacts, and from there, it can make an informed decision about where the inflection points for internal change reside. So this is behavioural change. And so far, this prong has had very little attention, but it really could be the most important in moving the needle. So how can these objectives be met? Well, in a number of ways. That's the point of this whole event. But let me focus on two in the time that I have, being mandatory reporting and also accountability through stakeholder vigilance. So there's a growing sentiment that only mandatory reporting can ensure high enough levels of reliability, comparability, credibility, and mass uptake to be effective. And we see this in the recent FCA announcement and legislative action in other jurisdictions such as France and New Zealand. And this is a really promising legislative trend, but so far the preferred form of mandatory reporting is comply or explain. And the question is whether that's sufficient for meeting the objectives of climate-related reporting as I've outlined them. Certainly, empirical evidence exists that comply or explain reporting, even though mandatory, produces a very mixed bag in terms of quality and therefore usability, and that's a problem for prongs 1 and 2. Certainly also harmonisation is important for comparability and consistency, something that I'm sure, Morgan, you will discuss more in depth. But even with a harmonised, integrated, perfectly perfect global reporting framework, it's only effective if the audience for that information is vigilant. That is, reporting is only effective if it is given consequence by a range of market participants and stakeholders. So this includes investors and shareholders, but also regulators, also directors, and other decision makers within a firm, and civil society. And really growing attention to this notion of accountability is evidenced. It's growing, and it's evidenced by recent complaints to the FRC by the environmental law firm Client Earth and shareholder litigation in Australia, all of which have focused on the non-existence or the inadequacy of climate-related disclosures. So in conclusion, I think it's important that no matter how we regard reporting, we need to be clear what it is seeking to do and to acknowledge that it's not a panacea. We've got to keep our eyes on the meta reasons for why we're doing disclosure. So that's market survival through an orderly transition. And really, more importantly, it's planetary survival through, amongst other things, systemic behavioural change. And that includes corporate cultural change. The fact is that we need to build a sustainable mainstream financial system, not one in which it's ESG versus everything else is reflected in reporting standards and practice. And this also means getting beyond a tick box mentality or a compliance mentality. And really, in order to fulfill the three-pronged logic of disclosure, as I've outlined it, we've got to avoid merely rearranging deck chairs. Thank you.
Great. Thanks, Megan. Obviously, there's some interesting points there which we'll come back to, but Paul, if I could just invite you to make some remarks, please.
Yes, thank you. And Megan sets it out very well. As an ex-regulator, I want to give a regulatory viewpoint on the issues Megan's just discussed. So first of all, to note in passing that those who work in financial regulation will recognise market discipline exercised through disclosure from firms is a standard part of the regulatory framework. It's pillar 3 in the Basel system, for example, after capital requirements and firm-specific interventions. So this is absolutely standard as far as regulation goes. And it's interesting that it was the Financial Stability Board which set up the Task Force on Climate-Related Financial Disclosures. Why was that? And Megan sort of talks about it. It's the fact is that financial markets, we know, are forward-looking. They can jump and they can move together when they do so. And you might think that climate change is not news, but it's fairly clear to most of us that financial prices do not yet fully recognize all the risks and opportunities from climate change in them. It is possible that markets wake up one day after some particular climate event or policy change and suddenly realize that a whole range of assets are overvalued, and hence you get the fire sale Megan talked about causing a financial stability event. So far, we've seen this for particular stocks which have gone bust because of climate-related matters. One thinks of Peabody Energy, which was partly related to change in US energy policy, and Pacific Gas and Electric, which was partly due to wildfires and a physical climate event. Both ended up in Chapter 11, and I've certainly sat across from investors who had those in their portfolio and basically lost their investment. So it is a genuine risk. We have seen that. Of course, we will never know how successful disclosures are to mitigate it. The idea, of course, is you put more information out into the market, the prices can then more accurately reflect the risks. And when there are surprises, the surprises will be smaller. But a lot of these risks have not yet occurred yet. They're not in the data. And so we can't really expect the pressure from disclosure to give an accurate impression of the risks, but they will push in the right direction. So it's certainly an improvement. Now, the other aspect of this, though, I think is much more important, which is around behavioural impacts, as Megan said. The first thing companies have got to do before they can disclose their climate-related risks is work out what they are. And most firms won't have known that because they never have looked before. And if a firm comes back to say, we don't think we have any material climate-related risks, they haven't done it properly, because nearly every firm does have. Any firm that owns a property or leases a property is exposed. Anybody that's in the City of London, which is subject to major flood risk, is clearly exposed. If they haven't worked that out yet, then they should do. But so the first thing a firm will do when it realizes its risks is change its behavior to mitigate them. And the second thing they're going to do is think, I've now got to publish this. I don't want to publish a bad story. I only want to publish a good story. And so they would try to change their risk profile to get that story right. We see exactly these effects from, I think, financial reporting. Financial reporting generally does serve to constrain firm behavior, but you've got to produce a set of accounts that are mark to market and whatever, then your behavior is constrained by that. I think financial disclosures will do exactly that. Will they be mandatory? Yes, of course they will. Governments around the world are very keen to prove their green credentials. If somebody gives them a set of disclosures they can easily endorse, they will jump on that. What will hold them back is two things. First of all, they don't know exactly what the disclosures should be, so they want somebody to tell them. And secondly, they won't want it to be so onerous as to cause a competitive disadvantage for their firms. And if they can be assured of that, it's pretty obvious. If somebody like TCFD or the IFRS comes up with a decent set of proposals, of course, governments are simply going to endorse them. And I'll pick up, I think it was Jumana's question as it came through. Will these be standardized? Well, a bit. But let's just be clear. We have different financial reporting rules around the world now for standard financial accounts. The playing field has never been level in financial regulation or any other sort of regulation. The best you can hope for is not to have a huge difference in slope between one end and the other, and you don't want huge pit holes all over the pitch. So standardization, a bit we can expect, and more standardization, the more the better, because then the easier it is for these policies to actually work. But don't expect perfection.
Great. Thank you, Paul. If I could just maybe add, Chair's prerogative, just to add some remarks, I think, from the user perspective, and some of the comments that we're hearing through from our signatory base. I think some of the principles that we want to see come through, which is that I think almost all sustainability issues, to some extent, have both a financial and a sustainability dimension. I think standards and disclosure should be designed to fulfill the data needs of users and to support their decision making across these dimensions. I think principally what we're hearing is that obviously we talk about we need to provide both current and forward-looking information to assess the full range of risk and opportunities, so your transition risks coming out, and the whole enterprise value creation component that Lucrezia commented on. But we also need to enable investors and other stakeholders to consistently assess and compare a company's sustainability performance and align that in the context of global goals like Paris. But we also need to recognize what's happening locally, I think, in terms of policy objectives and being able to contextualize that company information. So I think in order to deliver on these needs for investors, the corporate sustainability reporting system, we think needs to evolve. So I encourage to see what the IFRS is doing into a future state where reporting provides comparable and consistent indicators and metrics at the company level. But also what we're seeing is these metrics need to support new and emerging tools like taxonomies that investors will have to start disclosing against. We also need it to be mandatory and comparable across markets and sectors and activities, both on the financial materiality side and also on the company's sustainability performance. And also the global harmonization of this framework is critical, and appropriate long-term governance structure to support and the maintenance of such a framework is definitely needed. Ultimately, we need these. I think what we're seeing is we need to see that the reporting system that's emerging in part of the discussion treats sustainability performance and financial risks, I think, as a continuum and not, I think, as independent tracks. So I think this whole alignment pieces between what's happening with the various reporting aspects and the behavioral change is going to be really important for investors to start assessing the data information that's coming out. And if I turn to the IFRS consultation, I think itself in particular, in order to obtain, I think, buy-in and support for these standards and the solution that they're developing, it will need to, I think, both address these different concepts of materiality and the different users of this information over time. And in my conversation so far with, I think, PRI signatories, there's been a very strong and unanimous view that the proposal should tackle the range of ESG issues off the bat, not just climate. And in time, efforts also need to be taken to understand and align these initiatives that cover both the enterprise return, enterprise value creation part, but also the sustainability performance component. And it's that kind of system that we're really looking for. And it's encouraging to hear the scope which Lucrezia talked about, but also the timeline as well. I'm just conscious of time, and I think I want to sort of kick off with some questions. And I think building on this point around materiality, I think for you, Megan, I think one question is, what does materiality, single or double, look like in practice? And how can regulators and firms determine the materiality of climate change to a business? You're on mute, Megan.
Unmuted. Thank you so much, Morgan. So look, from a legal point of view, materiality, I think Paul's pointed out that materiality conceptually applies here, looking at physical risks of climate change, transition risks, whether that's technological, legal, market or market-based, and liability risks as well. They're all, these are all risks that are relevant to pretty much every firm on this planet. So that puts us in the ballpark, but it's actually quite a complex legal issue. So Lucrezia and yourself mentioned double materiality. Just even looking at single materiality, single financial materiality, is a really complex legal issue, which could take a whole event in itself. But I think, needless to say, that at this point in time, its exact definition isn't given in UK legislation. And company directors, it's at their discretion to determine what is a material financial risk to their company, within the legal boundaries of the best interests of the corporation. So I guess if a board decides that climate change is not material to their particular business, then they won't disclose it. So that's kind of where we're at. Now, how to get around that, the second part of your question. Well, I think in practice, one of the first questions that a board and of directors and also regulators, I think, are going to need to determine is the materiality question. What is material for their company? And I guess that in practice, start by compiling and evaluating their firm's exposure to climate change through scenario analysis and stress testing. But even the IASB has suggested that materiality could be tested, those thresholds could be tested against the reasonable expectations of shareholders and other stakeholders. Because right now, apparently there's a pretty massive gap between what companies are disclosing and what investors need to know or are expecting in relation to climate-related disclosures.
So if we shift from, I think, talk about the conceptual questions about materiality, Paul, I wanted to ask you a question, and I think maybe on the quantifying side then. So how easy is it to quantify the risks that actually are being disclosed?
Extremely difficult. Uncertainty is going to be the plague of this. I've been talking to bank chief risk officers, and the question they have been asking themselves in the last year or so is, how are we going to do this without the data? Because the problem is, of course, the worst of the climate risks have not yet happened. We know the temperature is going up. We know that the variance of temperature is going up. So we're getting not just more events, but sort of wider dispersion. But that's not in the data. And most of the quantified approach to risk management uses historical data. And so you need to flip that round. You need to be much more forward-looking, and you're trying to extrapolate a trend which is not fixed. It doesn't have fixed trend, doesn't have fixed variance even. And so it's really difficult. So you get into the realms of scenario analysis, what if scenarios. Actually, the insurance industry is probably much better placed to do this than the banking industry, thinking of the financial sector, because the insurance companies are used to doing stochastic simulation of their balance sheets tens of thousands of times with different parameter values. And that's the sort of different quantified approach you could take to try and get around this. So I think that's kind of just mention one other point here, which is what we're seeing a bit and going to see, I think, is something we also see with normal regulations, and we're actually seeing it with COVID-19, which is where people start to manage to the regulations rather than manage the risks. Yeah. And you hear a lot of that in discussion of COVID-19, people, what they can and can't do, rather than thinking, what is it safe for me to do? And we do, on this particular topic, need the businesses to keep focused on what should they be doing to protect their own franchise values, not worrying so much about the regulations. Otherwise, they won't end up doing exactly the right things.
Sorry, Megan, I could see you sort of, do you want to react to that statement?
For me, I love that idea. I think, yes, exactly. It's keep your eyes on the prize, it's, and I think the behavioral change that Paul mentioned as well is so crucial here. That third prong of internal reflection really needs to take off. It's a whole of company response that's required.
Can I just pick up on one of the questions coming through from Simon Jessup in the audience? What do you think of the move by some companies to adopt environmental profit and loss accounts, or the move by Harvard and others to look at impact-weighted accounts? Are they legitimate and a model for others to follow? Paul, do you want to respond?
Yeah, so I think there's a little bit of a risk with this. I mean, if people find it useful, then great. And I know that, for example, one bank has done internal capital allocation based on its climate objectives. And I think that sort of thing is great. But there's a risk of being overly precise and not seeing the wood for the trees and diverting activity into doing things which are very precise numerically, but then completely miss the point. I mean, the biggest risk here for most companies is business models. How is that business model going to adapt and survive in this environment? There's huge business opportunities, huge risks. And I look at current financial reporting and I see it far too overly precise. What we should be looking at with balance sheets, for example, is a distribution, the maximum minimum, if you like, over a reporting period, not just a point estimate at the end of the month, which people can adjust their balance sheets to hit targets with. So we do need to think about different ways of for reporting, but I think it does need to take into account the uncertainty, and traditional P&L doesn't do that. So, and doing P&L adjusted would also not do that unless you deliberately set out a regime to do it. So it's the risk here rather than the central tendency which we need to worry about.
Megan, do you have any reactions to that question, or no? Okay. I've got one additional question here coming through from Siobhan. Given the complexity of getting to good numbers that we can use for purposes of decision making, how do we get to disclosures that are useful but don't spend an inordinate amount of time getting to perfect data?
I think if you start with the TCFD recommendations, what do they talk about? They talk about governance. That matters. I mean, what really matters most for the performance of firms over the medium term is usually their governance arrangements. It's the G in the ESG, which seems to matter. Secondly, their strategy. Most firms aren't very good on strategy and don't, lots of people have plans, but they don't always have a strategy. Their risk management approach, that's a useful, how are people going about doing this? That's a useful disclosure. Only the fourth element is targets and metrics. So the numbers are only one part. They're illustrative. Obviously, you try and get the best numbers you can. You try and be forward-looking. You try to do what ifs. But it's not the only thing you should be disclosing because of the uncertainty and everything else. But people want to know how you're thinking about this.
Okay, I'm just conscious of time. I think I've got time for one more question, which I'll hand over. I think maybe slight shift in tact for you to Megan. We've identified some hallmarks of what a good global reporting standard should look like. Can we also identify what the impediments to this likely to happen or being successful and all the levers that we should make sure that it does actually happen?
Yeah, good. So I think, I think we've outlined a number of the challenges already, and certainly one of the biggest ones that's coming through is just behavioural, cultural. So that's going to be a space to watch. That's the systemic collective change that needs to happen. According to the IPCC, of course, we have only 10 years to make massive systemic changes. So I think we really need to throw everything at it. And I think in addition to disclosure, I mean, we talk about disclosure, but it's one tool in the regulatory toolbox. Regulators can use a broader range of regulatory tools to stimulate the herd mentality in the right direction. And we see this in other jurisdictions, in the Netherlands, for example, with their particular program in relation to behaviour and culture. And there's a number of different sort of potential tools that could be used here. So I think one of the biggest things that we need to get to, something that Mark Carney mentioned in April this year, that every financial decision takes climate change and the net zero target into account. And that's huge. That's a huge shift. But that's what needs to happen.
Great. Okay, so I think I'm going to leave it for the panelists to offer one final remark before we close off. So, Megan, final thought for the session.
Keep your eye on the prize and don't rearrange deck chairs.
Great. Paul?
Do we need IFRS rules on this? Yes.
Great. Okay. Thank you all. And I'll hand back to you, David.
Morgan, thank you very much. And also Megan and Paul, that was a wonderful first panel. So I'd like to hand over now to Martin Weale, who's Professor of Economics at King's Business School. And Martin will lead our next panel discussion. Over to you, Martin.
Okay, well, thank you very much. So this panel is to address the question, what information is needed by stakeholders? And we're very fortunate to have two people who are highly qualified to talk on that. The first speaker will be Morgan Despres, the Deputy Head of Financial Stability at the Banque de France and Head of the Network for the Greening of the Financial System. And he'll talk about a stock take, what's actually going on at the moment. And he'll then be followed by Luba Nikulina, who has 24 years of investment experience and is an evaluator of asset management for Willis Towers Watkins. So over to you, and of course, I'll be very glad to see questions. Please do type those in during the course of the presentation and we'll have time to discuss your questions afterwards. So Morgan, over to you, please.
Thank you, Professor. Thank you for having me today. It's a great pleasure, really. The first panel has been so interesting. It gives a lot of food for thought. So if you allow me, let me try to answer this question of what information is needed by referring to the latest reflections within the NGFS. I'm not sure I need to remind everyone of who we are, because I suspect the audience here is pretty much aware of what's going on the field of climate change. But maybe a few words. So the NGFS is a coalition, a club of central banks and supervisors who at some point decided to team up and pool their resources and efforts to try to understand better climate risks, the impact of those risks on financial stability and for financial institutions. So maybe 2 or 3 points I would like to make today. The first point is about how the NGFS is thinking around this topic of disclosure. As you may know, it is disclosure has been identified in the comprehensive report of the NGFS in April 2019 as absolutely key to achieve a proper risk analysis. There is one of our recommendations at the time in which we say that it's absolutely necessary to have a consistent, comprehensive, and coherent approach to climate and environmental disclosure in order to ensure that authorities are able to conduct risk analysis. So it's very key. So having said that, what can we do within the NGFS, as a group of central banks and supervisors? What can we do in practice to help? Well, actually, the first thing we asked ourselves was to say, is it really within our mandate of what within this issue of disclosure is within the mandate and what is not? And doing so helps us to identify 3 areas for action. The first area for action has to do with was Paul Fisher referred to earlier, is this issue of Pillar 3. It is clear that we cannot be responsible for financial disclosure as a whole. It's something more for market authorities to deal with. But still, a number of us have some supervisory powers, and we can impose under Pillar 3 requirements some specific disclosure to banks and also to insurance. But to do that, it means first that you need to have the proper metrics and indicators. You need to know which risk metrics you would like banks and insurers to use so that they can publish info of relevance on their exposures. And then you go back to the question again of this, chicken and egg story between data and disclosure. Because to produce, relevant disclosure, you need to have proper data. And sometimes you do not really know the data you need, and you need to define first the proper indicators and risk metrics. And I mean, here, it's something that we're working on within the NGFS. We have set up recently a work stream dedicated to data gaps. And in that particular work stream, what we want to know is, okay, so what do we need in terms of indicators and risk metrics? Do we have the proper data to do that? And if so, where can we find those data? Where are they? Is it a private databases, public databases? Not, we don't know. Or maybe they simply don't exist. So, I mean, here, the first objective is for us to help providing guidance on how to use Pillar 3 measures as a way to help having a consistent disclosure approach. And of course, finding out the proper data as well to feed into that sort of Pillar 3 requirement. The second point I would like to make is about something that Lord Turner mentioned in his keynote, is the necessity to have a dynamic approach, a forward-looking approach. And for that, what we could do, of course, definitely the pathways to a low-carbon economy would vary very much according to the sector. If you're BP, Chevron, Total, or another company, you're not going to have the same pathways. But within the NGFS, what we have been trying to do is to define a number of potential pathways, bringing together physical risks and transition risks, and trying to build some narratives that can be used by central banks, supervisors, but also by financial institutions, so that they can have a sort of consistent narrative that they can use to build their risk analysis and also to build their forward-looking disclosures. Because, of course, the last thing we want to have is a backward-looking kind of disclosure whereby you would simply take a snapshot at a given point in time and say, look, this is the particular exposures of that particular corporate, without necessarily having this forward-looking approach and trying to consider what is going to happen in 5 years, 10 years, depending on a number of assumptions. So I would say the second block the GFS has been working on is this issue of reference scenarios, forward-looking approach, and it's also extremely important as we see it. For us, it's an valuable contribution we can make to help having a forward-looking disclosure. And the third point is related to this issue of helping the others. In particular, in disclosures, you have the Pillar 3 approach, but then you have the broader, I would say, market discipline kind of disclosures that we are all expecting to happen. And to do that, of course, it is not necessarily the role of central banks to do that, but we can help others to do so. And here, clearly, what we want to do is to be in close contact with the IFRS, for example, but IOSCO, and I mean more generally, all standard setting bodies who are actually working on that tricky issue now. And as far as the consultation paper of the IFRS is concerned, definitely it's going to be difficult to have a single response from the NGFS, because the NGFS is a global network with 80 members now from all over the world, and there are necessarily some differences between regions and also different levels of advancement. So we're not going to have a single response, but we encourage all our members to provide some input and respond to the consultation so that they can help the IFRS understanding better the very specific framework and situation in each and every NGFS members. So we hope our members will respond in high numbers, and we also organized last week a specific webinars where the IFRS staff discussed with the membership as well. And maybe last word, as you rightly mentioned, Professor, we did a stock-taking exercise within the membership of the NGFS, and what came out of that was not very surprising. We had 36 responses out of the total membership, which is a very good number. And out of the 36, around 22 of them were currently in a situation where climate disclosures was not mandatory, but they were thinking of evolving, of course, at some point towards a mandatory disclosure. But to do that, they have also identified a number of obstacles, and it's not going to be a big surprise, but we get back to this issue of data, risk metrics, and also probably the lack of a proper supervisory guidance. It would necessarily help if supervisors could issue documents, guidance, expectations to help our membership being a bit more specific in the kind of data and disclosure they request from their financial sectors. So I will stop there, and be happy, of course, to answer questions and continue talking later on.
Thank you very much. Now, Luba, could we move over to you, please, and hear your thoughts on the ambition and the perspective from someone who advises on investment managers, please.
Thank you so much, Martin. It's a pleasure to participate in this very important discussion. So at Willis Towers Watson, as probably many of you know, we work with asset owners, and we help them define their strategy and also select asset managers. So in reality, I could talk about information needs for both asset owners and asset managers, but I thought that in my opening remarks, I will focus on asset owners, mostly because of the place that they take in the investment value chain. They are closest to our ultimate beneficiaries and savers, and also they have an incredible power and influence to decide who has access to capital and where new capital flows go. So just my observation around the mood and intentions in the asset owner community, it has genuinely been a wake-up call in the last year in particular, that the energy transition risk has become a genuine financial risk. So it's no longer a moral consideration. It goes beyond regulatory requirements. It genuinely, asset owners need to think about the energy transition risk for the financial benefit and well-being of their end savers. So Lord Turner, in his opening remarks, mentioned a number of asset owners who are a part of the Net Zero Asset Owner Alliance. Their number is increasing and they're committing to make their portfolios carbon neutral by 2050. We also see a number of more ambitious targets, such as the recent announcement from the BT Pension Fund, where the carbon neutrality objective is set for 2035. And across all three levels of scope. So it's very ambitious and impressive target. And our expectation is that this carbon neutrality by 2050 is very likely to become the default position for pension funds, not because of the regulatory requirements, but because of the financial interests of their members. Now, I just wanted to quickly talk about, there is so much talk about carbon neutrality, but what do we actually do with our portfolios when we set ourselves those objectives and targets? So if you think about an asset owner, they receive an information from asset managers who in turn receive information from underlying businesses. So if you are, as an asset owner, thinking about setting yourself a net zero target, you need to understand where you stand now. So you are getting information from your asset managers on what is your total carbon emissions. Then you try to look at carbon intensity of your portfolio. So normalize those carbon emissions by sales of underlying businesses, the economic outcomes. And then also you look at weighted average economic carbon intensity of your portfolio. So if you have a carbon intensive business that is a small portion of your portfolio, that's maybe less of a deal if it is a significant exposure. So as a result of it, you get a number of metrics that allow you to understand your carbon footprint at the moment. And let's for a moment assume that you rely on this data and think that it is consistent and reliable. Then you start thinking, okay, what does it show me? You can translate it into the scientific-based objectives. So what does it indicate in terms of the temperature rise? And it usually means that it's much closer to 3.5 degrees warming than 1.5 degrees. So in the majority of instances, as an asset owner, you need to do something with your portfolio to be able to move to this carbon neutrality. What are the options that are available to asset owners to achieve this carbon neutrality? Essentially, there are 3 at the high level. So you can divest. In theory, you could probably build a carbon neutral portfolio tomorrow, but it will be a very concentrated and very risky portfolio from a financial perspective. And also you just moved the systemic problem to someone else and you still face the risk of disorderly energy transition. Then the second lever, you can engage with underlying businesses. As an asset owner, you do it through your asset managers. You give them your top-down guidance on what you would like to see in the next 10 to 30 years when your objective needs to be achieved, and you rely on asset managers to engage with underlying businesses. And then the third lever is actually that you can invest more in positive impact carbon solutions such as renewable energy, carbon capture, reforestation. But the challenge with this solution is that there is just not enough of this type of solutions for asset managers, for asset owners to make significant allocations. So this is the journey that we are on, and this is the information that we are trying to get to be able to manage our portfolios to their carbon neutrality. I know that the next panel is going to talk about challenges, but I would like to just emphasize that it is indeed very challenging when we get this information. We have some data on equity and real estate. As soon as you move out of these two asset classes, the data becomes really opaque. It's not consistent. You also have this problem of materiality when you think about, is it just related to my business, my investment, when the risk that I face is systemic. And secondly, you have this temporal dimension that when you set yourself a target, be it in 2030 or 2050, you need to be consistently getting an information of how your underlying businesses are transitioning. Are they meeting their targets for you to be able to meet your targets? So with this in mind, it's a tremendous challenge, but as always with the harder the challenge, the bigger is the prize. Earlier this year, we created a working group of investment consultants in the UK that includes 17 firms that pretty much represent the investment consulting market. And we are currently working on our response in support of the IFRS consultation, because we think that this is genuinely an opportunity to try and move the sustainability reporting in the right direction. So with this, I will stop with my opening remarks and hand it over back to you, Martin.
Well, thank you very much. Now, I have a number of questions which, perhaps I'd be glad for both of your views on. I mean, I take the point that data are an obstacle, and that's inevitably a recurrent theme. But how far Lord Turner made the point about, it's not only numbers, it's also text that counts. And there's an important role for that. And perhaps in describing what risks are material, that can be done textually, even when the risks can't be quantified. So how far do you think there is more that can be done, to help the investing community, to help the users of company reports in terms of disclosure of material facts? Do you think companies are pulling their weight, or could they be doing more? Well, Luba, to you first, perhaps.
Okay, thank you, Martin. Well, we are here because more needs to be done. And the question about whether it's quantitative or qualitative information, and my view as a user of this information is that both need to improve. There is definitely need for better and more consistent quantitative metrics. You can only manage what you can measure. That's an obvious truth, and you create incentives better when your metrics are measurable. But then the problem, the challenge that we are discussing, it's almost unavoidable that we will have to rely on certain narratives and qualitative assessments. So Lord Turner is absolutely right highlighting that, especially when I think about our attempts to monitor engagement activity of asset managers. It's really hard to make the qualitative metrics consistent. You end up being guided towards several examples of success, while in reality, what you need is the broader picture of how the engagement is happening. And the new stewardship code here in the UK is genuinely the step in the right direction. It will help the industry, but there is more that needs to be done at the level of underlying businesses and how they report their transition plans, so as asset managers can make their reporting and send it back to asset owners.
And Morgan, I mean, you commented rightly that your powers are limited, and there's a question of what standing you have, that you can't be responsible for disclosure as a whole. But do you think there are more things that your group could be doing to encourage reporting of material risks, even in the absence of firm data?
Yes, sure. I mean, the industry can definitely do a lot, could probably do more. And maybe if you allow me, let me make my favorite point. This is a point about taxonomy. Because what we observed in our own exercise when we tried to identify exposures of our banks and insurance companies, we sometimes really struggled to be able to identify sectors which were more specifically exposed to climate change compared to others. And to give you a very concrete example, the large exposure metric, for example, that we use very much in our supervisory world, it measures the exposures of a specific bank to a specific counterparty. Well, the problem is you can use it as a metric in your Pillar 3 requirement, but currently you won't be able to know what sectors specifically, within the sector, what is specifically exposed to climate risk. For example, you would know that a given bank is exposed to, I would say, Total or BP, but within BP, you don't know which activity in particular. You couldn't tell it's windmills or it's oil, or gas. So you don't know that. So in short, in some cases, the data you need just don't exist, and you would never find it, because in order to have it at the granular level you need, then it takes a specific action for policymakers to define and to classify with a sufficiently granular approach the sectors and the exposures. And I think this is probably something that would help a lot. And here, not only green taxonomy, but also non-green taxonomy. And if this is really the shopping list, and on top of it, possibly as well with a dynamic approach, because you have some sectors today which are non-green, but which may be green in the future going forward. If some specific technologies are coming up. So in short, a lot can be done. I think the industry can do a lot, we can do a lot, but at some point there would be a need for policymakers also to step in and to help provide some clarity on the number of topics, in particular, clearly a clear need of definition and taxonomy, call it the way you want it.
And could I ask a further question, please? No, I was struck by the point Lord Turner made about the charity that wanted to disinvest from a bus company because the bus company had carbon emissions, as bus companies inevitably do. Is it possible or is it helpful for stakeholders to put these issues in the broader context of relative to the general pattern of demand in the economy? In other words, that half a loaf getting people to use buses rather than cars may be a lot better than no bread, having them staying in their cars, and we shouldn't see it as as a failure of a policy or a business to be avoided. So how can one place the reporting in this broader social context, please? So maybe Luba, your thoughts on that first.
Yeah, no, it's a very good example, Martin, that Lord Turner gave. And I think he said that one has to be intelligent about it as an investor, yes. But to be intelligent about it, you need to have the information, because, we all know how much information we get as investors. There is an information overload. So to be able to make intelligent decisions, this fact that this bus company is actually a better long-term investment than some of the alternatives somehow needs to flow through this information chain and get to the top of the agendas of the trustees who make those investment decisions. And let's just bear in mind that at the moment, at this level, asset owners, we operate mostly at asset class, big investment decisions rather than individual businesses. So it really requires the whole investment chain to step up their game in terms of making those decisions and ensuring that we make them on the basis of the right information.
Yes, I mean, I suppose really I don't know how this information could be produced, but really the issue that I know that Lord Turner's example gives rise to is that we need to distinguish emission reducing businesses from low emission businesses. And the question is how we identify the emission reducing businesses. And that obviously has to be seen in the broad social context. You can't just tell from looking at a balance sheet or a financial report whether a business is emissions reducing or not. But maybe Morgan, I could ask you that question. Can you see perhaps a part of a solution to that problem?
Well, sorry, it's not because I'm French, but I will go back again to the role of governments. And I mean, here, the issue is, if you want to achieve carbon neutrality in 2050, you need to make sure that you give sufficient clarity to investors over a sufficiently long time horizon. And it has to do with investment cycles. And in some cases, you may have to continue investing in some gas emitting industries or devices for a little while before you can move to a fully carbon neutral approach. And typically, I once talked to some people active in the cemetery business, and they were telling me that they had to change sometimes some of their how do you call that, burners? Well, don't know the precise term anyway, which still issues CO2, but much less than the current ones. And by doing so, they will be in a position to dismantle them shortly before 2050 and move to a fully low carbon kind of business line. So, sorry, I'm not very clear. But what I meant is that if there is clarity as to the pathway, as to the carbon pricing pathway as well, clarity on the technology and the opt-out, a phasing out period that will be applied, then you can give a chance to industry to develop their investment cycles in a consistent way, and you can give guidance to the consumers and the stakeholders as well. You can tell them, look, okay, it's the best company, that's true. We are going to emit CO2 emission, that's true as well, for a few years, but as of this year, we'll switch to less carbon emitting or to a fully low carbon neutral mean of transportation. So what I meant here is we need to have close coordination between industry, between the financial sector, central banks, governments, and the complexity is really that everyone needs to work in close coordination. If we don't do that, at the end of the day, we may have some kind of mismatch and wrong signals. And at the end of the day, consumers may say, okay, I don't understand. It's a mess. So I will simply stop investing in best companies or airlines, and that's it. And this is probably not what you want to have.
No. Well, Luba, could you offer your thoughts, please, on better coordination? Is there more that the different agencies could do, coordinate, so as to ensure that investors are better informed, stakeholders are better informed?
Yeah, absolutely, Martin. Well, the topic
good
of
question.
today's...
I mean, sorry, this is not a question for me.
No, sorry, I was putting that.
No, sorry. Sorry.
I'll come back to your after.
We can
no problem.
Both answer, but I did want to bring it back to the IFRS consultation because their initiative is actually an attempt to improve this coordination, and to a degree, from everything that I see in the industry, there is genuine desire and willingness to coordinate. That there are so many different initiatives that it almost creates too much complexity. And bringing some streamlining there would be incredibly helpful. And the IFRS is in a great position to do so. And also, just going back to the bus company, there is this discussion about whether the IFRS is being ambitious enough from the start. And then you can only capture the bus company situation if you do cover the double materiality. And that's why there is definitely an encouragement for the IFRS, maybe not from the start, but definitely have the ambition to cover the double materiality to ensure that our decisions are intelligent.
And Morgan, you certainly wanted to say something on that.
Very quickly, because I know we're running late. I'm afraid it has to do with, at the international level, of course, you need a strong multilateral cooperation, and you can hope that the G20 can somehow help. It has been difficult last year and the year before, but which you may hope is going to change going forward. And at the national level, it also calls for some specific platform. Some countries have set up those platforms in the Netherlands, for example, in the EU. And this is a platform where we bring together all the various stakeholders and the governments, and they try to agree on a roadmap and to discuss on a regular basis. I'm afraid you have to do that if you want to have a consistent approach, because at the end of the day, it's really the real economy which needs to transition.
Okay, now can I just ask one question, please, from Jemana? When can the industry expect to see common disclosure standards? And perhaps you could offer your thoughts on that at the same time as wrapping up the session. So, Luba, do you have any thoughts on when we might see common standards, and any more general remarks, please?
Well, from everything that we heard today and from what I have been hearing consistently, both from our clients, asset owners and asset managers, our partners and suppliers, the sooner we can resolve this problem, the better. But obviously the discussion today shows just how complex and multifaceted this problem is. The time is running out of us, so the climate challenge is definitely an emergency, and as a result, we should be galvanizing our efforts and trying to resolve it as soon as possible. But the answer to this question is genuinely at the moment is not possible. I can only say the sooner the better, and we all should be trying to do our best to contribute to the speed of the solution.
So, Morgan, please, do you have any thoughts on that and some general conclusions?
Yes, I'm here.
Please.
I agree. I mean, we can't afford to wait until we have the perfect data, the perfect models, the perfect whatever. We need to live with imperfection, and it's a bit frustrating for us, in particular for central bankers, because we don't like to make decisions in a very how could I put it, unknown and unstable environment. But we have to do that. So again, the sooner the better. I think we're good on a way to do that. The IFRS, I would encourage the IFRS people to move quickly, and the quicker the better, really. Even though sometimes we don't have all the accurate data we need, we will learn by doing.
Well, thank you very much. That's been an absolutely fascinating discussion, and I'd like to thank both of you on behalf of all the participants in this seminar. Over to you, David.
Martin, thank you very much. That was wonderful. And Morgan as well, and Luba. That was a very enlightening discussion. Let me pass the floor now to Richard Monks, who is Director of Strategy at the FCA. And Richard will lead our next panel.
Morning, all. Yes, as David has said, my name is Richard Monks. I'm the Director of Strategy at the FCA in the UK. I'm absolutely delighted to be chairing this panel this morning, and would like to thank David and all colleagues at King's for inviting me. And also to thank in advance Spencer Dale from BP and Vim Bartels from KPMG for sharing their expertise. So we're near the end of the year. 2020 is almost over. Thank goodness 2020 is almost over. I think many of us will be thinking it won't go down as a legendary year for the world. The fight against COVID has been a hugely significant global event, but I think it is really interesting that despite that, the fight against climate change has still featured constantly in headlines throughout the year, and a lot of progress has been made. It seems now that policymakers, regulators, industry, the wider society all increasingly recognise the urgent need to adapt and post-COVID for our economies and for our societies to build back better. Complete, consistent and high quality climate related disclosures are critical to the transition. They will drive effective pricing, they will drive risk management and capital allocation. And the recommendations of the TCFD have been a really critical catalyst for change. And according to the TCFD's status report from this year, more than 1,500 organisations have now voiced their public support for the recommendations. I think it's fair to say that progress in disclosing against the recommendations does continue to vary. It varies by company size, it varies by sector, and disclosure is often patchy across the 4 pillars of the recommendations. So there has been progress, but there is much more still to do. And certainly from a UK perspective, we think that driving further progress will probably require a shift from voluntary to mandatory reporting. At the FCA, our first step will be to implement a comply or explain disclosure rule for commercial companies with a UK premium listing. And we will be publishing final rules on this by the end of the year. But we recognise completely that this is not easy. Even if the whole world, all different bodies think this is a good idea, it is not actually easy. Stakeholders have told us that access to data remains an issue, that it is difficult, it is expensive to build the analytical and the modelling capabilities to analyse future scenarios and to quantify financial impacts. Competition concerns, litigation risk have always been raised with us as issues, particularly in regard to disclosing future strategies. And these practical barriers and how we might overcome them are the focus of this session over the next half hour. And I'm delighted to be joined this morning by 2 very distinguished panelists. Firstly, Spencer Dale. Spencer is the Group Chief Economist of BP plc. He manages BP's Economics and Energy Insights team, which provides advice and analysis on the global energy system, on how it is evolving on the path towards net zero. Prior to joining BP, Spencer was Chief Economist at the Bank of England. Secondly, Wim Bartels. Wim is KPMG's global leader for climate-related risk services and also KPMG's partner for corporate reporting in the Netherlands. And as a member of the TCFD, he has helped drive change in how organizations identify, assess, and manage climate-related risks and opportunities. So I will first invite each panelist to make some introductory remarks. I will then pose a couple of initial questions to the panelists to start the Q&A session. I'd encourage all of you to put questions into the Q&A box. We are operating virtually, of course, but we'd like to make this as interactive as possible. But starting with you, Spencer, what do you see as the top 3 challenges faced by companies in making climate-related disclosures?
Thank you, Richard. I can give you top 2 rather than 3. I'm not sure I have time for 3. I wanted to start, so it's just in the spirit of the workshop, I wanted to start with my own disclosure. And my own disclosure is, I fear I'm not the right person for this panel. I'm not an expert on accounting or disclosure standards, and I don't lead on these issues for BP. So these are very much personal comments and not the views of BP. My defense is I am heavily involved in thinking about the energy transition and the implication that has for BP. And these issues are clearly hugely important. And so when David Aikman approached me, I couldn't resist. So the fault all lies with David in terms of picking me as a panel person. In terms of background, earlier this year, BP announced a major pivot in its own strategy, including an ambition to get to net zero by 2050. And I'm very happy to explain what we mean by net zero in the Q&A. And as part of the aim supporting that ambition, we set an aim to become a recognised leader in transparency for our sector, including supporting TCFD recommendations. So these issues we're discussing today are very important to BP. And I also wanted to make 2 points concerning some of the challenges I see from my perspective. The first is I think there's quite a strong tendency amongst companies and investors to blur or combine the different types of risk and materiality. And this relates to the single and double materiality that Lucrezia was speaking about earlier on today, and others have been speaking about it. So the single materiality, which talks about the risks posed to the value of the company by the energy transition and climate change. And the double materiality, which also then takes account of the impact of the company on the sustainability of the planet. Although those two sorts of risks are clearly interlinked, they are distinct. All investors should care about the single materiality. All investors should care about the financial risks posed by the energy transition or posed by sustainability issues. But different investors will quite legitimately care about different aspects of double materiality. We talked today about, and Lucrezia talked about this, that we can think about in terms of climate risks. Other investors may care more deeply about a broader frame of sustainability, which takes account of to do with land, water, the ecosystem more generally. Others may take account of a broader frame even more generally in terms of thinking about a company's contribution to sustainable development goals. What contribution are you making to improve the access to energy in other parts of the world? And so different people have different views, and the metrics and disclosures used to assess these different forms of materiality are quite different. This all may seem very obvious to this group, but in conversations I've had with investors, these two concepts often become very blurred and intertwined. And so one plea, I guess I would make to the IFRS, and which I think Lucrezia picked up this morning, is that we keep a clear distinction between these two sources of risk and materiality. They're different and distinct, and different people have different views. And I think often I'm in conversations where they get confused. The second point relates to a sort of a more technical point, but it's sort of in interaction with my sort of world, and it concerns the use of climate scenarios to help assess financial or transitional risks associated with the energy transition. So this is one part of that single materiality point. And I start from the basis that to be useful for the investment community, whatever benchmarks or scenarios are used as the basis for the disclosure, they need to be simple and easily comparable across countries. So simple and easily comparable. In that context, I don't think climate scenarios, at least in terms of the current state of the science, are fit for purpose. And that was really brought home to me by the recent work by the NGFS, which Morgan was talking to. If you're not familiar with this, I'd really encourage people to look at the work of the Network for Greening the Financial System. It's extraordinarily impressive and sets out a set of state-of-the-art scenarios for different carbon pathways. There's an obvious question here about which carbon pathway should we use when assessing financial materiality, but I think that problem can be solved. We can think about a pathway we think consistent with Paris. What the NGFS work highlighted for me, though, was even once you've decided on a given pathway, if you then analyze the implications of that pathway for the energy system using different state-of-the-art models, you can get really quite different outlooks for the energy system. And the NGFS work uses 3 state-of-the-art models, and for a given pathway, they get 3 really quite very different pathways and implications for the energy system. And so I fear that using climate scenarios as the basis for assessing financial stability financial materiality will almost inevitably end up having to pick a particular arbitrary pathway. And so I was wondering, is there a simpler approach to thinking about this where we can sort of make progress? And I start from the basis that all the companies subject to the disclosure rules we're discussing today are price takers in energy markets. So in that sense, the risk they face is not that they won't be able to sell the energy they produce or trade, but rather the price at which they sell it may fall sharply. Given that, does that mean we can shortcut the use of complicated climate scenarios and go straight to price metrics. The outlook for energy prices will clearly depend on the views about the speed and nature of the energy transition. But my guess is that by averaging across a wide range of different scenarios, it'd be relatively straightforward to construct a set of ranges for different energy and carbon prices, which could then be used to test the resilience of companies. We can be agnostic about the exact pathway for oil or gas underpinning that range of prices, but we could come up with a range of prices. The attraction of this approach would meet the simple and easily comparable criteria. And if a particular group of investors had a different view of prices, it'd be relatively simple for them to ask companies to use an alternative price band. So I guess my question, which I wanted to put to this group and to Lucrezia in terms of the IFRS review was, as a first step, should we drop the focus and discussion of climate scenarios per se and turn our attention to developing some simple price bands as one element for the disclosure of financial materiality?
Spencer, thank you for that. Although I must say, your initial disclosure of suggesting you weren't the right person for this panel, you've completely blown out of the water by two really, really interesting points, which are suddenly sort of making fired up my brain over this lunchtime in response to thinking about the response to those. Before we focus on those particular areas, Wim, can I turn to you? And initially, I was going to ask for sort of you think the three main challenges are. Feel free to stick to top three challenges or to follow Spencer and just go for two. But Wim, your initial thoughts on the challenges faced by companies in making climate-related disclosures.
Yes, thank you, Richard, and Spencer too for your introduction. I'm sure we discuss that in a second. And if you allow me, Richard, I will relate to the challenges both from a company and from an auditor's perspective, because there will be a moment in time where auditors will have to take their part in this, I would say. But that they are a kind of parallel. So, and I see three challenges that I would like to touch on. The first being on the criteria, and it relates partly to Spencer's comments too. And I say this with a bit of my KPMG hat on, but also with my TCFD hat on, so a bit of combined. And when you look at the TCFD framework, then and you take it in relation to the IFRSs, for example, you can immediately see the differences in terms of the level of specificity and or the level of suitability. And deliberately, the TCFD took an approach to have 11 recommendations on one page and start every recommendation with describe, without saying exactly what you need to describe, to what level of detail, and what the definitions are that you should use. There are some suggestions in the recommendations, but it has not been clearly specified in all detail what it should be. And for companies, that is already a struggle. I see that also in practice when you say, describe the risk and opportunities that you have identified. Well, I can do that in 3 bullets. I can also spend 2 pages on it. And the same applies and even more to scenarios. How do I describe scenarios? What do I disclose on them? Which assumptions do I disclose? Which one don't I disclose? What do I do with quantification and disclosing on these results? And that applies to almost every recommendation. And as I said, there are strong parallels here to what is a challenge for the company and for auditors. I think the first that needs to be resolved is to set clear, specific requirements for climate-related disclosures, in addition to what the TCFD has done, and with the help, of course, of the work of other frameworks that has already been done. But with the elements that need to be disclosed and in what way, in addition to the definitions to be used for data specifically. Then there is also an issue on the same with the fact that if we want to have useful information, it needs to be future oriented. And that is challenging for companies to disclose on not only the next 12 months and take the average annual report and you see what companies disclose on the average 12 months ahead, and that is not really a lot. So think about the same, but then 5 or 10 years ahead, or even 20. That is very, very challenging, because easily investors take your disclosures as being the things you expect, forecasts, targets, etc. And it aren't. But you can easily be held to account for these. So this is all around my first challenge, the criteria and the level of specification of all of these. Then the second is an internal one, relating to the robustness of processes and systems and controls. We're really new in the space of climate-related financial disclosures. We are relatively new still in the area of climate-related disclosures, read carbon emissions and the like. And even though that is around for some time, I experience not on a daily, but maybe on a monthly basis, that is still challenging to report on a company's carbon emissions, particularly if we go into the nowadays more requested or required Scope 3 emissions. You come with estimations, with ways of calculations, and how do you organize your internal processes and systems to the same level of quality as you have for financial information, where for financial information you have a different, a different setup, because we work with a double bookkeeping, double entry bookkeeping system, and we don't have that for carbon emissions. And then with that, and I heard in the previous panel on the relevance and the importance of text in addition to data, and I'm very much behind that. The data is nothing if you don't explain what it means, where you're going, and why you got into the data that you have got to. So the balance and completeness in reporting, and again, the right processes and systems around that, is a further challenge for companies. And again, that is in parallel to what auditors face equally, or will face in future. And then finally, but before I do, by the way, for the IFRS Foundation, I think that element of disclosure in addition to the data and the balance and completeness of that is a very relevant point to consider. So then my final point, again, relating it also to the IFRS Foundation, is about the links between non-financial and financial information. And if we look into that, then we come with a number of challenges. First of all, it is the understanding within companies, but also, again, within audit firms, about what that means, right? How do carbon emissions relate to the valuation of my assets and my liabilities? What does it mean for my risk disclosure? And to understand those links and understand what climate risk and opportunity really mean and that is what I experience on a daily basis, is a challenge for most companies. Then the rest comes with, what does that mean for proper reporting, and for proper financial reporting in particular? And you may be aware of the recent paper by the IAGCC on the request to disclose balance sheets that are in line with the Paris Agreement. That is a real challenge. Honestly, I think, without discussing that in any detail in light of the time, I think at this moment it's impossible. But the idea is very relevant. Any company that says we are on a 2-degree path, but then value their assets still as if it is business as usual, that is, of course, an intrinsic contradiction. And how do you deal with that? And again, for the IFRS Foundation, I think it's very relevant to look into these linkages from the start of developing any climate-related disclosure framework or sustainability reporting standard. So those are the criteria, the processes and the controls, and the links between non-financials and financials. And with that, and given the remaining 11 minutes I see we have, I give it back over to you, Richard.
Vim, thank you for that. And again, key points there coming out, which I think we can have a discussion around IFRS and what those proposals may look like. Lucrezia, I may turn to you in a second to pick up particularly Spencer's second point and Wim's final point there. Before I do, just a couple of quick questions from me. Spencer, can you give us a sense of the journey BP has been on to date and how you've thought about climate-related considerations in governance, strategy, and risk, and enhancing your disclosures? And what sort of practical challenges have you faced so far?
Yeah, how do we do that in a few minutes? I think it's enormously. So I guess first of all, when we're trying to think about how to frame our ambition, we wanted to frame our ambition in terms of an absolute target for net zero. And partly that was based on just thinking about what the world needed, which was not a reduction in carbon intensity, but an absolute reduction in carbon emissions. And it was partly just because this becomes so complicated, we sort of set ourselves with a task of, if I had been a lift with my son or daughter and they asked me, what company are you working for? And what are they doing to contribute towards climate change? Could you explain it during a lift journey? And our one was the carbon footprint of the oil and gas that we extract from the ground will have a carbon footprint of 0 by 2050. And that felt a pretty clear and simple way to explain to people what we meant by net zero. So that's how we started this process. Trying to then find ways about both articulating how to measure that and, more importantly, this is picking up a point that many have raised this morning about laying out a pathway so people don't have to wait till 2050 to see if you're credible, but they can actually intervene so that you could give some clear guideposts along the way. And what pace do you have to achieve to get to 2050 in time without being too fast or too slow is an enormously challenging thing. And I think our view at the moment is we're almost certainly wrong. But we got as many people telling us we're going too fast as we have people telling us going too slow. And so we'll start there and we're developing change as our understanding, the world's understanding gets better.
Thank you, Spencer. Wim, the comparison you made between the financial disclosures and some of the traditional financial disclosures and the climate change disclosures. As an auditor, I imagine a company saying, we're almost definitely wrong, but if we have the balance of the right people on either side saying we're wrong for different reasons, we've probably got it right, which Spencer, I think, is entirely the right approach in this setting. Wim, from an auditor's perspective, I'm sure that wouldn't normally give you that much assurance. So how do you see the audit world, the support world? How can you see those set of companies really helping listed companies in this space?
Yeah, I think what auditors can do to get us to now we're certainly right is, I think, a few things. One is to help with what I refer to as the processes and controls. So to say, like, you may not be able to get to exactly the right information, exactly the right pathway, etc. But we can help you with making your processes robust. And as an auditor, right, because you're not an advisor, you're an auditor, to challenge the models being developed, to help with potential anomalies in those models, and with that help in getting to better information. Of course, auditors also there need additional knowledge themselves, right? So it can't all be financial auditors because it's quite a specific topic. So you'll need sustainability experts, climate experts within or outside of the firm. The second, I think, that we can help with is getting to the right level of transparency and putting out the information in the right way. That is to say, such that it is, of course, accurate, but it's also balanced and reasonably complete. And I say deliberately reasonably because with this new type of disclosures, companies are really on a journey. And many are a bit struggling with going out too soon with climate-related risk information because it might put them at a competitive disadvantage, being earlier than others, and with that creating additional insight into risk that they face that haven't been spotted for others. So to get that reasonably complete and help companies on their journey, that I think are the first steps. And then over time, it will move into types of assurance, right? In types of review to make sure that the information that goes out and gets published is indeed correct and complete, in line with what to report on the financial statements side. I think that those are a few of the things that auditors could, but I would say also should do.
Yeah, I mean, I imagine this is going to be the growth area. One would have thought in that business, developing those models and providing all the help you can, the consistency across firms, etc., are going to be a huge but fascinating challenge. I'm just conscious of time, so I think we have a hard stop at 12:30 for this session, and the next session is to some extent, I think, going to focus on IFRS. Spencer, did you want to just articulate? I think you had a question for Lucrezia earlier, or a proposal about how we could think about sort of ultimately pricing to perhaps cut through some of this challenge.
It was just when I'm thinking about, and it's something we've done at BP when we're trying to think about risk and materiality. Trying to think about it in terms of precise scenarios is an incredibly difficult thing to do, because as the NGFS work really highlights, even if you know the carbon pathway, if you then simulate the impact of that carbon pathway using 3 models, you get 3 completely different views about the implications it has for different aspects of the energy system. And that's no criticism, that's just where we are in terms of the state of the art. So I wondered if you could just flip it around, and partly because I think it'd be easier, but also be far easier, I think, for investors to be able to think about. Suppose we were able, by averaging across a wide range of scenarios or doing stochastic simulation on certain models, say there's an 80% probability that in a Paris consistent scenarios, oil prices average somewhere between, say, $45 and $70 a barrel over the next 20 years. And that's with a big say, right? So different people have different views about that, 45 to 70. But you could write down 45 to 70 and say it's not 100%, but a very large part of the probability mass will be in that range. Assess your company across that price band, and you can do the same for oil, for natural gas, coal, carbon prices. And then you could then that would be a relatively straightforward thing for investors to see exposure to. And if some investors say, actually, I'm far more worried about oil prices averaging $30 a barrel, they could ask their company that they invest in to do it on $30 a barrel. And in part, it was just trying to think of a metric which people were more familiar with, and which I think would be easier to do than come up with a precise scenario, which, in the spirit of Paul Fisher's point earlier, could be precisely wrong, because we just don't know enough about what the energy transition will look like. And so why don't we just accept that and try and flip it? And my instinct was to flip it in terms of these price bands as a first step.
So I think the focus on simplicity is certainly very appealing, and I think we've had a comment in the Q&A to that effect as well. Lucrezia, did you want to sort of briefly comment on this? And then, conscious of time, it might be a fantastic segue, David, into the next section as well.
Yeah, I mean, I will briefly comment. I mean, both Spencer and I have a background as macroeconomists and scenario analysis in central banking for quite different purposes. So, well, I think it's an interesting proposal. I mean, but I'm not sure it would be simpler, though, because you still have to average across scenarios and come up. I mean, it would be simpler in terms of communication because you'll come up with a metric. But, still you'll have to have scenarios, and therefore at the end, some amount of judgment, and this is inevitable. There is another aspect, as I understand the TCFD framework, which has to do with, this is an exercise which is more similar to risk management than actually to standard setting. In a way, it is kind of an hybrid, and therefore the scenario is a tool in that respect to understand also the business model. And I think there is a kind of murky area here in which standard setting, risk management, and actually governance, in a way, they're all related. But I agree with you that for somebody who comes from outside like me, it's kind of confusing, okay? So that some, I think there will be some learning by doing, I guess. But the TCFD is the way, the starting point, inevitably, because that's where experience has been accumulated. But the new board under the IFRS, if there will be one, will have to look at that also with a fresh mind. I think that not just absorb passively, the recommendation.
Lucrezia, thank you for that. We're just at 12:30 now, so I'd just like to say again, just a huge thanks to Spencer and to Wim for their contributions. Another really interesting half hour. I can't wait to go away and talk to my team about a number of these ideas, certainly, and I hope many of you attending the session feel the same. Lucrezia, thanks for responding as well to that specific question there. So over to you, David.
Richard, thank you. That was a really fascinating discussion. Thank you, Wim, and thank you, Spencer. It's lovely to see you again. Very thought-provoking ideas. I'd like to hand over to Franz Burkhout, who is Executive Dean of the Faculty of Social Science and Public Policy at King's, also Professor of Environment, Society and Climate. So Franz, over to you.
Thanks, David. So I'm the chair for panel 4, which is about governance for global standards and the potential role for the IFRS Foundation. I think in this final panel, we'd like to discuss the potential role for the IFRS Foundation in developing a harmonized set of global reporting standards for climate-related risks. A first overarching question here is, whether the panelists, and we've got 3 great panelists whom I'll introduce, see a need for a global standard, a global set of standardized disclosure rules in the first place. I suspect I know what the answer is there, but some nuancing there would be useful. A next sort of question is, whether the IFRS Foundation should indeed expand its standard setting activities into this area. So it's a question for the foundation itself. And then finally, what does success look like? To what degree does a streamlining of reporting standards, is it reasonable to expect that others will follow the IFRS's Foundation's initiatives in this area? We have 3 speakers. So the format of this session will be that we'll have 3 short 5 to 7 minute interventions by 3 speakers. Then I have some initial questions to ask each of them. And then we'll try and, if we have some time left, we'll open the floor to participants in the session. The first speaker will be Lucrezia Reichlin. She's a professor of economics at the London Business School and is an IFRS trustee. The second will be Clara Barbie, who is the chief executive of Impact Management of the Impact Management Project. Is a project that is looking at sustainability issues in reporting and management. And then thirdly, Sheldon Mills, who's the interim executive director of strategy and competition at the Financial Conduct Authority. So I think without further ado, I'm going to hand over to Lucrezia.
Thank you. Thank you, Franz. And, by the way, thank you, everybody, because, this is very important for us. This engagement with all of you is part of, the credibility of our consultation, the legitimacy of our consultation. So I think the question you pose is, do we need global standards, and, what are the challenges? So I want to be kind of quite transparent about that and say, this is a very difficult problem, and it's a very difficult problem for many reasons. Well, first of all, because, we have to be clear of why we want standards in general. So on climate-related risk. So on one way, you can say investors want them, and they want them to assess risk. And, so this is why we want to have an investor focus. But on the same time, the fact that investors will get these standards, that could be itself a driver of change and lead us to a better world, so to speak. Then there is another set of client, if you want, who want standards because they want to go to a better world. Okay, they want it to, to do good. And the objectives here and the kind of standards that you may think, and also the global versus regional aspect of the standards are related to this discussion. So you want, on one hand, investors, different kind of investors, some who want to change the world, some they want just to assess the risk. Then you have the stakeholders and the regulators. And then you have the policymakers, and the policymakers may have some objectives, and these objectives may differ across jurisdictions. For example, not for all countries, the Paris Agreement it's in the legislation. It is for the European Union, for example, but it is not for the US, of course. So on one hand, this, we know that if we want to do anything with climate, that has to be global because it's a global problem. And so we want a global solution. But, regulations, public policy, legal frameworks, and so on are very diverse. So for the capital market, this is really a global issue. But, for different, policy jurisdictions, this is not. And, so a single global standards for the investment community makes sense. And, and in this context, I mean, the role of the IFRS, in my view, would be key, as a federator of other initiatives and so on. But, it's inevitable that the national governments elected on different mandates, facing different, social challenges, environmental challenges, will have different views on what those standards have to be. And, in this tension and in this difference, then there is the whole questions of what is the legitimacy of and what is the scope of a global standard setters. So I would have, to organize this discussion, I think the first important question is, okay, but if we want to have an aspiration for a global solution because climate is a global problem and because we all want at least, to push capital, well, he has to go, okay? So what is the best way to go there? And, should we have a global reporting structure from the start, like the one we are recommending? Or should we go for, each regional jurisdictions go wherever they want to go, and there will be some kind of regional competitions. And in a way, you can think, for example, the European Union, which is possibly the most advanced in these areas, to lead the world as exporters of regulation, as they have done in other aspects, for example, in competition policy. Now, I think, and this is in a way is what drives also the motivation for the consultation of the IFRS, that if you have a global aspiration, at least for the investor community, I mean, to go global from the beginning, it's a better way to get to where you want to go. And if you want an example for that, think of the difference between the IFRS and the GAAP. The IFRS started as a global standard setters for financial accounting. It is now, their recommendations, their standards are adopted by more than 140 countries, while the GAAP started as a US thing and they remain local. So I think that if we build from that experience, I think, there will be, a lot of resistance for the EU to actually to lead the EU or any other jurisdiction to lead the world. So that's the first comments I would have. The second comment is, okay, if we think that you have to be global from the start, what is a legitimate and effective model of governance? And a model of governance that does not lead to a lowest common denominator, okay? So we want to have a global aspirations, but we don't want this to mean that we're going to do very, very little because, there will not be, because of this heterogeneity, in governments and so on. So this is where we come from our proposal of saying, okay, we want to have this nesting approach that I refer, at the beginning. So we will set a minimal, minimal core standards, but we'll, continue to have an open dialogue with those jurisdictions which want to go further, and so that we can actually evolve in a kind of nested and coherent way towards, more ambitions. And also, this has to be seen dynamically also because, as we know from the previous conversation, it's going to be really difficult, okay, to get to anything that is, really coherent, comparable, assurable, auditable, etc. So I think to articulate this global regional, framework is key for the success of that. And I can see also that, we need to think of that in a dynamic way. So we should start narrow, but we should think of, possibly, increasing our aspiration. Oh, I have a thing to say, but maybe I should stop here, and then I'll take the questions in the second round.
That's great. Yes, we'll have a chance for a discussion. So I'd like to ask Clara Barbie now to give her brief intervention at the beginning. Thanks.
Thank you, Franz. So much has been said already about materiality. I want to just recap that briefly to pick up on Lucrezia's points and then talk about practically where things stand today in terms of the work that we're doing. IMP is, as you said, it's a project. We're unusual. We're a facilitator, a technical facilitator, and we work with standard setting organizations of a broad range globally, including UN agencies, the OECD, the IFC from the World Bank side, but also importantly for this conversation, the 5 standard setting organizations that guide the overwhelming majority of disclosure today about companies' impacts on sustainability. So that's CDSB, CDP, GRI, IIRC, and SASB. They're often referred to as the group of 5 at the moment. And that the work they're doing is really important because they have so much they have learned over the previous years on this topic, and therefore so much to contribute to the vision of IFRS and how it might play a role in this area, depending on the consultation. So along with the World Economic Forum and Deloitte, we've been facilitating the group of 5 to come together and define a shared vision and a statement of intent to work together towards what we've called a comprehensive corporate reporting system. And Lucrezia has referred to this in her prior remarks today. She referenced the idea of an architecture, whether you call it a system or an architecture. I think the important point is that we need to have a conversation about the roles of different organizations in the context of thinking about the complete set of information that all stakeholders need from companies. And so the group of 5 worked earlier this year on this shared vision, published it in September. And there are 2 features of a comprehensive system, which again, Lucrezia's reference that I just want to bring to life, that have been expressed as very important. One is this idea of nested information, and the other is the dynamism of it. So the nested sets of reported information, the reason why we've been using that concept is just in recognition of the fact that corporate reporting needs to serve different objectives. Again, much of this has been discussed already, but very briefly, the framing in the paper that we used was of nested. We visually used a diagram that showed nested boxes of information, with the biggest box being the disclosure of a company's significant impacts, all significant impacts of companies. And that's particularly relevant to achievement of public policy goals globally as expressed by the SDGs, also at the jurisdiction level. It's also, of course, relevant to a range of other stakeholders, consumers, employees, and a growing set of ethical and impact-driven investors. But then you have a box within that, which is the disclosure of those impacts that have become business model dependencies and they're driving enterprise value. And so if you were to imagine scope 1 emissions being reported in the big box to enable achievement of policy goals, in the middle box, you might have disclosure of gross scope 1 emissions, but actually break that down if you're in the aviation industry, for example, into the percentage of fuel consumed that's sustainable or alternative, because it's that additional disclosure that provides insight into the business model levers available in that industry to drive change in scope 1 emissions. So you get that important level of detail that is going to enable you to create change at the business model level. And then finally, we need to recognize what is depicted as the small box, which sits within the middle box, and that is the disclosures of business model dependencies driven by sustainability matters that are already reflected in the financial statements. Impairment of property, plant, and equipment, for example, on the balance sheet, or increased operating expenses due to gross scope 1 would be an example of how that information gets expressed in the financial statements. Now, the nested sets of information, as Lucrezia has explained, is a useful framing, because then you can talk about a global, what Lucrezia called a global core, insofar as you've got the IFRS Foundation already addressing the small box. It is a natural extension, therefore, to think about reporting on enterprise value, how sustainability matters drive enterprise value, that middle box, as an evolution of what we have in terms of financial reporting today. It is information that is material for investors. And then finally, that we need to recognize that the relationship between the boxes is dynamic. So I've given the example of gross scope 1 carbon emissions, and I've done it deliberately because it is a topic which, as I've explained, is relevant to all three of those nested sets of information, albeit reported and expressed in its reporting perhaps in different formats. But there are other topics which may only today sit in the big box, maybe about a company's impacts on the world that are not yet currently being reflected in business model dependencies and therefore in enterprise value. And those topics can move. And with COVID-19, with Black Lives Matter, we're seeing some topics move rapidly from being what might be perceived as sustainability reporting to drive SDGs into actual enterprise value reporting to investors. It's financially material if they're looking over the long term. And so that dynamism is the reason why it's technically so important, is that it means that however this comprehensive corporate reporting system is constructed, there's got to be a relationship between the standards that guide companies to report on how sustainability matters affect enterprise value and those that they are using to report on sustainable development to meet public policy goals. Because when a topic moves, you don't want the measures associated with that topic, when they should be the same, to be unnecessarily different. So I just wanted to highlight that in my comments as an important technical feature that needs to be taken into consideration as the IFRS thinks about its role going forwards. I will just close with an observation on the practical path forward. We've been working with a group of 5 recently on a paper that will come out soon, which follows their joint statement of intent, but it looks specifically at this enterprise value reporting to investors that goes beyond what is captured in the financial statements. It's the middle box I was describing. And what we've observed is that the conceptual framework for financial reporting is applicable for the middle box too. However, there are some really interesting extensions that could be required in order to make it completely applicable for that box. And what that does, I think, is highlight why it makes so much sense for the IFRS Foundation to be considering, providing a home for the standards that guide enterprise value reporting, because of that connectivity with the conceptual framework. Finally, I will close by saying that, practically speaking, the group of 5 have welcomed the IFRS's consultation of playing a role in this area, especially for standards that meet the needs of the capital markets. In an open letter to Eric Fedin, and Sheldon's going to speak next, they wrote to the chair of the Sustainable Finance Task Force of IOSCO and called on IOSCO to play a role in bringing the threads together, bringing the work, the content of the existing independent standard setters on how sustainability matters affect enterprise value, together with the IFRS and the potential ambitions it could have in this area. And I will just close by saying that, this really becomes real when you start to see organizations actually think about how they can take very practical steps to enable progress. And a very recent announcement I wanted to highlight in that respect is the SASB and IRC, who have come together and said, we're actually going to consolidate our governance. We're going to become the Value Reporting Foundation. And we are deliberately in the press release, actually, CDSB was also referenced. as an example of another initiative that could come under that umbrella. Now, the reason why that's exciting and is where I wanted to end is that you can see these organizations saying to the markets, not only are we going to bring together our governance and try and make sure that we create the connectivity of our existing content, but we're going to call it a stepping stone, because we recognize that ultimately this may actually serve the ambitions of a standards board under IFRS. So at the moment, I'm extremely optimistic that we're seeing threads come together, and it's a very important time for you to be hosting this conversation.
Thank you very much, Clara. Some very, very important points you make there. So we'll move swiftly on to Sheldon Mills. Sheldon, you're welcome.
Thank you, Franz. Thank you for inviting me today. So just to remind people, I'm Interim Executive Director of Strategy and Competition at the Financial Conduct Authority. I'm speaking in that capacity, although I also co-chair the IOSCO's work on issuer disclosures in this space. But I'm not representing official IOSCO views this afternoon. I mean, I think that your first question was, do we need to do something here? And the answer to that is yes. And I think we're at a critical juncture in this journey towards better corporate reporting on climate change and sustainability. And the IFRS Foundation's consultation is really an excellent opportunity for us all to engage as industry policymakers and regulators with this issue. We at the FCA recently published our response to the trustees consultation, and we also joined the UK government and other financial regulators in issuing a joint statement of absolute support last month. And in our response, in welcoming the Foundation's work, we voice our strong support for move towards a common international standard for sustainability reporting that builds from the TCFD's recommendations and other existing frameworks and standards. And we really think that the trustees' proposals can help meet the needs of capital markets and advance all of our objectives of securities regulators in this area. At the end of the day, it's a globally connected financial market, and a common international standard is going to improve completeness, consistency, and comparability of corporate information on sustainability. And it will provide the bedrock of future assurance of this information. So then I suppose the second question is, well, where does this standard come from and how do we develop it? And we do think that the IFRS Foundation is a natural candidate to take on that standard setting role in collaboration with the Alliance of Five. You can make a movie out of the Alliance of Five, couldn't you? And you get some superhero kits or something. I mean, there's a few reasons for that. The one is that the Foundation, has widespread international market acceptance in financial reporting. So there's that bedrock of acceptance, which you do need. You do need that confidence in order to supply something consistent and standardized. And that's supported by its governance arrangements, which focus on integrity, independence, transparency, and public accountability. So I think there's considerable benefit in integrating standard setting for financial and non-financial reporting to capital markets under a common architecture. Just turning briefly to IOSCO, I'm co-chairing a work stream at IOSCO on securities issuers' sustainability disclosures. And in that work, we've had close collaboration with the IFRS Foundation and with the work of the Group of Five that Clara is leading at the Impact Management Project. And I think together those initiatives can really deliver the information content that capital markets need and the independent governance arrangements that are going to be essential for widespread market acceptance. So at IOSCO, we are committed to helping join the dots between those initiatives and help influence their direction. And I think we're in a unique position to assist the IFRS Foundation in that future role, given our long history of collaboration with the IFRS Foundation. Just to remind people of that, in 2000, IOSCO issued a resolution that set the foundation for the adoption of IFRS across member jurisdictions. And today, we have 144 jurisdictions using IFRS. And IOSCO provides the chair of the monitoring board, which is a crucial layer of the foundation's governance. So again, that foundational bedrock for a common international standard in sustainability to sit somewhere which could get widespread international market acceptance is really critical. We can talk a lot about the detail in terms of the metrics and how to do this, but if it has no place or no home, it ain't going to work. I think it's important to think about how we get that done. So before, and Lucrezia has mentioned that many jurisdictions will have their own targets in terms of climate change, their own issues in terms of governance and social elements, and maybe working towards different paths. So that element of, we describe it as the building blocks, but you can describe it as nesting, etc., is going to be really important as we move forward in this area. And I also like Clara's points around what I describe as dynamic materiality or dynamic alignment, that we all know that the metrics and things will absolutely shift as we move forward into the future and we do more work and more data, and also as certain societal and environmental risks grow and the social attitudes and political policymakers' attitudes towards them grow and develop. I think we've seen a sea change in the past couple of years, and that will continue. You do need a mechanism to ensure continued alignment. And one idea from us is that supporting the IFRS Foundation's work and the potential Sustainability Standards Board might be a consultative committee which looks at a sort of superset of sustainability standards and is able to continuously advise in terms of potentially the shifts and changes and patterns and deals with this dynamic alignment and gains consensus because of its own authority. But that's just an idea. It's not even something which we've really talked very much at IOSCO, but one to put out there for discussion. Thank you very much.
Thank you very much indeed, Sheldon. So we thought there might be, initially anyway, three sorts of questions which we could ask each of the panelists to respond to briefly. The first is, do panelists agree with the proposed climate first approach, which is begin with climate and then open out to a wider range of sustainability issues? The second is to do with, the question is in practical terms, to what extent should the IFRS Foundation develop sustainability standards with the financial materiality or enterprise value creation lens, thereby remaining coherent with the Foundation's current mission, rather than taking a more ambitious approach, including double materiality? So this question about financial or double materiality. And then the third question is, can we articulate what success might look like, and over a time period that is kind of reasonable and foreseeable, I suppose, there too. So perhaps we could start with Lucrezia. If you could just, meditate on some of those questions. Thank you.
Yes, okay, briefly. Climate first, in the pre-consultation that led to the consultation paper, that was a strong message we got from most stakeholders, that although everything is important and connected, climate is the most urgent. And also in terms of challenges for developing the standards, it's quite different, okay, because of, the horizon issue and so that just to develop those, technical expertise and to do it in a way which is sufficiently authoritative and, it would be, maybe from a pragmatic point of view, better to start from that, and then remaining open, and this is the document that is quite clear about that, remaining open in enlarging the scope at a later stage. So is our suggestion, and we'll see what the consultation will come up with. On materiality, as I said before, okay, so that in a way, the experience of the IFRS Foundation is the investment focus. Okay, this is our DNA. The TCFD and other organizations have the investment focus. The idea is there being that, if investors get good information, good standards about the risk related to climate and so on, this will drive change because they will be the subject of this change. However, as I said before, this is not that clear because, the different investors may want to also have the to do good objective that I was referring to before. And not only the investors, but also the stakeholders. And, the two materiality aspects are not, although conceptually you can distinguish them, they're not that easily distinguished them when you get to examples. And coming from financial regulations and banking, I always like to make the parallel with financial regulation, with micro financial regulation and macro financial regulations. Okay, so you can do microprudential, but still, if you don't take care of the interconnections and the macroprudential aspect, then that will eventually feed back. And so we have to be aware of that. And this is why I think the idea of doing it dynamically, as Clara has suggested, and we also suggest in our document, is maybe the most obvious way to go. I mean, the most safe way to go. Success, I think that to me, the legitimacy issue is very important because, as soon as you get away from the pure investment focus, which, and so the capital market, then, it becomes, who decides becomes very important, who monitors, who decides. So I think that in that sense, the IFRS is well placed because I think that our three-tier structure ensures that through the monitoring board, we have the monitoring not only of the market regulators, the IOSCO is very important for us, as has been said, but also the FSB, where, the Minister of Finances are there and so on, so representing, if you want, the political democratic process that at the end has to be behind all that, okay? There is a discussion about whether the monitoring board should be enhanced also to include, civil societies and other important stakeholders. But I think already this structure is quite, I think is one of the strengths, one of the big motivation of why the IFRS should be here.
So, Clara, maybe I could invite you just to think about those three questions.
Absolutely. I think so everything, I'm going to sort of draw on the conversations I've been part of, which obviously include with all the standard setters, but also beyond. And I think everyone understands the rationale for leading with climate to that point. In fact, I should have mentioned that the reason why the standard setters now are looking at this development of a prototype standard for reporting on climate-related financial disclosures is because they recognize the urgency of climate and need to lead with that. And that prototype, which is really aiming to demonstrate how quickly this can be put together given their existing expertise. It's not meant to be a standard, it's a prototype only. But it's being done using the TCFD architecture and honoring all of those recommendations. So it's really trying to bring that all together. And I say that to stress that we recognize the importance of climate. However, there is no question but that everyone feels it must be leading with and not only. And that's coming from the perspective of investor demand, particularly, and the need to look at all issues that are driving enterprise value. And I think I would just want to add in practice that the reason why it seems important to stress the need for broader disclosure standards is because of the content that already exists today from the standard setters, which is not just limited to climate. So if you think about, I think, and you will know better than I, everyone else on this call, but the IASB adopted the IASC standards as a starting point. And then I think in 2003, the PCAOB in the US adopted the AICPA standards as its starting point. So there's this precedent of adopting existing work that's gained traction, and TCFD and SASB and integrated reporting are good examples of that in terms of serving enterprise value. And the fact that they SASB and IRC are already broader friends, I think is a good example of why people feel that it can go beyond climate relatively quickly. I'll just close by, the question on materiality, double materiality, etc. I think that one of the things I've observed, particularly when looking at the leadership of the European Commission in this area and what is being called for from their side, is that actually the framing of non-financial reporting, as is used there, it can suggest that you effectively put together the sustainability reporting to a broad group of stakeholders with the reporting to investors on how sustainability matters drive enterprise value, and that sits together. And then you have financial accounting standards as we have them. In our technical work, we've observed that it is, and I say this as IMP, it is a more obvious evolution to have the reporting on how sustainability matters drive enterprise value sit with the standards for financial accounting that we have today, because of the connectivity through the conceptual framework and the way in which those therefore completely can guide companies to report on enterprise value as relevant to investors. So I think that's just an important technical aspect to keep in mind. And I do think that in terms of how that then relates to the broader reporting on all significant impacts that Lucrezia was referencing, I want to stress how important that reporting is. I mean, it is actually that reporting that can often drive topics to become material for investors. We have to have that reporting elevated and given the same status. But I think it's important just to recognize that at the moment, looking at jurisdictions that are requiring that, they are being led by jurisdictional policy priorities. And it would be interesting to see, I just share this as a reflection, the extent to which a global solution is called for what we call the big box. Because at the moment, what we're witnessing is actually jurisdictions looking at it vis-a-vis specific jurisdictional policy priorities. So I think we just need to be aware of that and see how that evolves.
And success, what does success look like? Just briefly, in your mind?
I think I would stress the equal status point for success, Franz. We have to have a system that honors all stakeholders in terms of corporate reporting. And I think it would be a failure not to arrive at that system. That does not mean that it is the role of the IFRS today to provide that comprehensive system. It means that the decisions need to be made in the context of what it means to get to a comprehensive system.
Very interesting. Sheldon, can I invite you perhaps just to reflect on those three questions?
Sure. I'll be brief given time, but yes, given the urgency of the climate challenge, we support an initial focus on climate change, but we do think it will be important ultimately to broaden the topic scope of sustainability reporting, and that we'll need to do that reasonably swiftly. Because I think there's plenty of evidence that a wide range of environmental and social factors are material to enterprise value creation. But we do need to make some progress. And I think a climate first approach is really what I'd call a pragmatic approach to ensuring that we can make progress through the IFRS Foundation reasonably quickly to issue climate related reporting standards. And I'm hopeful that the association with the Group of Five and the fantastic work that's being undertaken on the prototype, which Clara mentioned, will really accelerate that pace once we get the foundations for the governance for the Sustainability Standards Board, if that's where we move forward to. I think it's important that we do try to keep pace as well. With the ambition of the COP26 private finance agenda. I think we've got an opportunity there in the next year to really rapidly move things forward. And then in terms of retaining an investor and capital market focus, I really like the way Lucrezia described the macro and micro the thought process. I'd like to give that some thought. Actually, I haven't really thought of it in those terms before. But I'd add that when I think about macro and micro economic ways of thinking about markets, I often think of the demand side and where incentives are coming to drive change. And I think, in a sense, I think there will be a head of steam beyond climate first and into other areas. And I think we're increasingly seeing that. And that will come from people. It will literally come from people in society, everyday working people who invest through their pensions directly or who work in businesses and they wish to see change. So I do honestly believe that those incentives will drive up through the system, and eventually we'll be wise to think about how we have the frameworks to respond to those. But I am, as I said, I'm pretty pragmatic, and I do think that actually the benefit of the IFRS Foundation, the benefit of what you might call a financial reporting type lens to this, is that we will get, I hope, a good framework, and that framework can be iterated and built upon to support a much wider group of standards across other elements of ESG. And I think we're really looking forward to working with Lucrezia, Clara, and others as this moves forward. And again, as I mentioned, we do think that part of that could be a multi-stakeholder expert consultative committee, which starts to think about this superset of sustainability topics and metrics. So it isn't actually imposing those on anyone, but it almost is a bridge between other forms of metrics and the work that the IFRS Foundation might be focusing on in Climate First, so that we don't actually lose pace and we continue the journey. And that moves me on to success. What does success look like? We're building an ecosystem of reporting. And I think success to me is getting the right governance framework in place. If we could get hundreds of jurisdictions actually accepting that framework is one which they will sign up to, even if that is just on a climate first basis, that is massively successful. A couple of years ago, we would have said that was extremely ambitious. So for me, that's the first step of success for this particular topic. Another element of success, I think, is ensuring that there is a bridge between other, not competing, but developing approaches. So Clara has mentioned the EU's approach. I think it's really important that as we move forward, that there is a sense of commonality, or that the jigsaw puzzle can connect between the developments there in terms of getting towards common sets of standards.
Thank you very much for that. All three actually very, very interesting and detailed and complex reflections. So I think just to wrap up, what I'm hearing is a fairly strong yes to IFRS playing a prominent role in this process, which I think is generally welcomed. It's very important that there are more common standards. Secondly, I think that there's very much to work on, both in previous accounting and reporting standards, of course, but also in the, now quite substantial 20 or 25-year tradition that there is around sustainability reporting. I think there's a sense of a need to be pragmatic. On the other hand, also to be ambitious and dynamic, to see this as a start, and then over a series of phases, probably over a longer and shorter period of time, taking the advantage of COP26 and so on, and other important political milestones at the global level, to move forward expeditiously. And clearly, in the end, it's going to be a very interesting balancing of the needs of business, of the investment community, of policymakers and governments, but also, as Sheldon reminds us at the end, of consumers and investors themselves. Actually, they will play a very important role in driving and demanding all of this as well. So I want to thank all of you for giving some really interesting thoughts, and I hope that also contributes in a very forceful and useful way to the consultation. I'm going to hand over now to David. Thank you.
And thank you very much. And Lucrezia, Clara, Sheldon, I think that was a wonderful way to end the policy forum. I'll just briefly finish by thanking everyone who's spoken today. I'd also like to thank our audience members who've participated actively by providing questions, some of which have been excellent. A recording of this will be put up on our website, so you'll be able to kind of watch any bits you've missed or rewatch bits you found particularly interesting, and then will be submitted as part of the consultation. Finally, a special thanks to the events team and communications team at King's Business School, who've kind of made this all run in a smooth, seamless way, which is always involves a lot more skill than is apparent. And also to colleagues at the IFRS Foundation Secretariat, who are very helpful in us putting this program together. So with that, let me draw this to a close, and let's keep this discussion going. Thank you all.
Thank you.